financials to do well, you need a better picture for growth, for loan growth. Higher interest rates often helps as well. When most people are predicting quite the opposite, yet at the same time they think financials will do well. What's changed? Why is this different?
It's actually less about rates for large cap growth, or sorry, large cap financials than it is for kind of mid and small financials. If you get rates down, and that is going to accelerate economic activity, you're looking through a potential short and shallow economic downturn to the other side. And where financials are priced right now, they're basically priced for some slowing in economic activity. So you can buy ahead of that. Back to what I said before, market pricing is going to move ahead of when economic reality happens. And I think that's the story in the bull case for financials right now.
Just in terms of cyclicals, Best Buy coming out with their earnings and seeming to confirm your feeling, raising their earnings per share forecast, and those shares are popping. So if you look at consumer cyclicals and discretionary buying, you do see ongoing strength in some of the reports that we've been seeing, Drew. I'm just wondering, from an overall perspective, though, how hinged is your broadening out call to the prospect of significant rate cuts by the Federal Reserve, given that some people call those into question, given the strength that we're seeing ongoing in the consumer?
Not significantly, actually. There's actually a difference between kind of the Main Street consumer company and the Wall Street consumer company. There's a lot more, let's call them themes at work. Think e-commerce, experiential commerce, and so on, where consumers are still spending money. So yes, rates coming down does help that story. But I think the S&P 500 consumer names are just less cyclical than your broader type of consumer company. I think people need to recognize that when they think about consumer stocks versus the economy. And then the other piece, do we need the Fed to cut a lot to support valuations? Not really, because we've had the 10-year come down, and we've actually seen the 2-year come down and rate volatility come down. All of those things are supportive of higher equity multiples.
Drew, we've got to leave it there. Appreciate the updates, sir, and the clarity from the team at Citi. Drew Pettit there. The latest on their outlook, overweight financials, discretionary. Looking at cyclicals, Lisa, looking for this recovery to a potential downturn in the not-too-distant future.
You know, I want to actually listen to that again, because some of what he was saying was kind of interesting, the idea that some of the cyclical companies in the S&P 500 are less leveraged to the economic cycle than we may realize. But when you just broaden out, he's not alone. So many people are talking about this.
Heard it tons.
And you've really put it perfectly, which is all these people are preparing for a recovery to recession that is never going to happen. At what point?
Well, I don't know about never.
Well, okay. Well, that has not happened.
Or that they're not expecting.
That they're not expecting. So this is sort of a tension that people have just sort of moved past, and I think is still a very real tension.
Try and stay neutral here, Bramo. Nvidia down by 3.8%. Futures doing okay so far this morning. Let's get you an update on stories elsewhere. Here's your Bloomberg brief. Israeli forces carrying out the largest military operation in the West Bank in years. Palestinian health officials claiming 10 people were killed and several more injured. An Israeli spokesman claiming Iran has smuggled weapons into the West Bank, with this week's operation serving as a preemptive strike. Kamala Harris is on her second day of a 2-day bus tour through Georgia. She's heading through rural areas with a focus on shoring up support among black men. Harris is also getting ready for her first interview since taking the nomination on CNN later tonight. And finally, competition is underway in Barcelona for the world's oldest international sports trophy. Boats from Italy, the US, Great Britain, Switzerland and France are competing for a chance to capture the America's Cup off Holders, New Zealand. The first America's Cup race took place in 1851. Did not know that.
You ever done a regatta or anything?
No. I'd be terrible at this.
Really? Well, I once did that in a mini fish.
Did you?
Yeah, when I was in junior high school.
Oh, right.
Yeah.
So you can sail?
Yeah, I used to be able to.
Motorboats?
Yeah. That's on brand. I would just say, you know, this is the kind of regatta where you go around.
The hard work. And then, no.
Yeah. No. Pull in the mainsail.
Nope.
Use the rudder.
Motorboats.
Good to know. Good to know.
Up next, NVIDIA's AI reality check.
Hyperscalers represent about 45% of our total data center business. We're relatively diversified today.
That conversation up next from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Stocks are positive here by 0.2% on the S&P 500, waiting for jobless claims 1 hour and about 14 minutes away. The bond market not doing much. Your yield 383.30. Under surveillance this morning, NVIDIA's AI reality check.
Hyperscalers represent about 45% of our total data center business. We're relatively diversified today. We have hyperscalers, we have internet service providers, we have sovereign AIs, we have industries, enterprises, so it's fairly diversified.
Here's the latest. NVIDIA's underwhelming forecast hitting tech stocks, threatening to cool the AI trade that's boosted companies like Meta and Alphabet, which rely on the chip maker for scaling AI operations. At the same time, concerns growing about anxiety and exactly how much these companies are dependent on NVIDIA for AI expansion. Bloomberg's Mandeep Singh joins us for more. Mandeep, good morning to you. Concern you've had for a while, supply. And I think for the CEO, you don't just get to say supply is going to improve without really explaining why you think supply is going to improve. Did you get an explanation yesterday?
I mean, he was alluding to the fact that TSMC is able to ramp up their supply at their end, but I think the expanding supply will not just help NVIDIA, but others who are trying to make similar chips, whether it's on the training side or inferencing side. And to me, you know, if supply is expanding, lead times are coming down, that's never good for your pricing. And it was evident in the gross margin guide that they give. So Q1, it was like upper 70%. This quarter, it was like mid 70%. And going forward, also, the commentary was gross margins are probably going to stabilize around here. 2025, who knows? But clearly, the gross margin side seems to have peaked.
Can we spend some time on the execution issues around Blackwell? Just what exactly is the manufacturing yield? How low is it compared to where you'd expect it to be? How complex is manufacturing something like this?
Yeah, so look, I mean, TSMC is the one who is doing the manufacturing. NVIDIA is coming up with the design. And what typically happens is with any new architecture, yields are extremely low at the beginning because they're packing more transistors. You know, it's doing more in terms of the memory that it's using. And look, it's not surprising to hear that yields were low initially and they're trying to solve the problems. And he seemed to be very upbeat about Q4 Blackwell contribution. So all that is great. I think on the demand side, the product side, the commentary was great. This is, to me, the real standout was the gross margin commentary, the fact that they expected to really, this could be the peak, and they expect it to come down, albeit gradually. So net, you know, hyperscalers commentary was good. Sovereign, they called out Sovereign being low double-digit contributor. The question that I have is it sustainable the same way as the hyperscaler CapEx is? We know hyperscaler said they will continue to ramp up the CapEx through 2025. I mean, we know governments don't keep just spending CapEx like this, the way hyperscalers' balance sheets are. So I think when you look at their customer base and you look at the growth expectations, the catalysts for further upside revisions are fewer than they were last quarter. And that's where I think you see a negative reaction. There is no growth cliff anytime soon. This is more about, is it going to keep surprising to the upside? And I would say the incremental data center revenue was, again, $4 billion. There's no seasonality in the business. So the $4 billion revenue, despite all the positive data points that we got, you know, from hyperscalers, sovereign, China, even China business was up sequentially. Still, the beat wasn't that big. So that's where I think the market is looking at and saying maybe there is some digestion that will likely happen in the second half in 2025.
Mandeep, can you elaborate on this idea of margins peaking? Is this basically just running out of pricing power, or is this just simply getting pushback, having to broaden some demand? I mean, what exactly is this?
Yeah, so think of it this way. Anytime they launch a new architecture, it tends to get a higher price because the chip is more advanced, it can do more, and customers are willing to pay a higher price if there is no competition. So in this case, Blackwell should command a higher price, and that should add to the gross margin the same way the Hopper did when they went from the previous architecture Ampere. Now, what sounded on the call, again, the CFO wasn't very clear, is 4Q gross margins will be around mid 70%. They didn't guide to 2025, but clearly they're spending more on the component side, the memory that goes into chips, so that benefits Micron. They're spending more on the foundry side. TSMC is raising their prices to NVIDIA. So all the supply chain costs for NVIDIA are increasing, and that will impact the gross margins that NVIDIA can command. They're a fabless company. They don't make their own chips.
Okay, pause. This is actually fascinating. Are you saying essentially that NVIDIA's suppliers are saying, hey, we need to get in on this game. We're going to raise prices on you guys, and that NVIDIA cannot turn around anymore and say to the likes of Microsoft or Google, okay, you just have to pay us more?
I think so. And again, this is happening very gradually. So it's not as if, the gross margins will compress 500 basis points in a quarter. That will happen when we are at the end of the cycle. There's nothing in the demand commentary that suggests we are anywhere close to that cliff. But clearly, semi companies are, profitable during the cycle when things are going very well. And as the cycle ends, their gross margins shrink. So in this case, because NVIDIA doesn't make their own chips, they can't control how much supply chain charges. And the supply chain is raising prices. The Micron is raising prices. TSMC is raising prices.
All this being said, they still were great results. And yesterday, you said you really enjoyed the interview that Jensen Huang did with Ed Ludlow of Bloomberg. You could feel his frustration. We did everything. Why aren't you embracing us? Do you think that the market response was appropriate?
Well, so market is driven by whether we'll see more positive revisions to EPS. Is the 2025 EPS number low, and will we see positive consensus revisions? If not, the stock will go down because the stock is driven by, how much the estimates will go. Are they growing into their valuation? And the answer is the top line commentary was great, but because of the margins, the EPS revisions will not be of the same magnitude. And that's where I think investors will take a pause and see, okay, do we have visibility to 2026 and beyond? Because that's what will drive the stock from here on.
The big test now is the use case. Apple, September 9th. What are you expecting for them to unveil?
I mean, Apple is the one hyperscaler. I put them in the hyperscaler bucket because of their size. That hasn't ramped up CapEx. Every other company is spending more on NVIDIA, ramping up CapEx to deploy their large language models. Apple hasn't because they have the distribution, and that's what they'll focus on is how can they use the smartphone, the distribution they have to deploy these large language models and still participate in this Gen AI wave. And I think they will show that it's just not having a model is still something that, is a constraint when it comes to the competition.
What can they announce to get us to upgrade? What can they announce?
Well, so remember, Apple designs their own chips, and they can do inferencing for large language models, and that's what Apple Intelligence, the platform they announced, is all about. That you can, even though they don't have their own large language model, you can use OpenAI, you can use other large language models on their phone, and it can offer you the functionality that everyone is raving about when it comes to generative AI, whether it's Copilot or, chatbots and some sort of assistance. So you'll still be able to use it. It's not an Apple model that you're using.
Let's see what we get. Mandeep Singh of Bloomberg Intelligence breaking down the story with NVIDIA and looking ahead to September 9th and that big unveiling of the new iPhone.
I love this. What can they announce to make us upgrade? That was quite the us. It was doing a lot of heavy lifting there, John.
Other people interested as well. Show's not just about me, Bramo.
Well, is it though? No, I'm kidding. But to be really honest, do you want to upgrade?
I'd be close to upgrading. It's been a few years.
What functionality would you actually be interested in?
Better battery.
That's it, right?
Yeah, sort of baseline.
It's not about something that's going to wake you up and be like, hello, John.
No, I don't need something to manage my day. That would freak me out.
Have you
You seen those kind of commercials at the moment that the future's not scary? I think the future's scary.
That doesn't surprise me.
Don't you think the future's scary?
I am optimistic.
Are you
I
really?
think that actually there
You're
could be some
optimistic
really...
about nothing.
Okay, look, the one thing that scares me is if AI can process information, extrapolate answers faster than humans can.
Yeah.
At what point that becomes a sort of ability to affect change in ways that are out of our
In a good
control.
way? In a good way?
In a way that's out of our control. I mean, what's to say that humans are better decision makers than algorithms? Maybe we're not.
Don't know outsource to algos.
I mean, I don't know if they're good algos.
Okay, you go first. NASDAQ futures right now, up a 10th. Coming up, Heidi Kripo-Rediker of the Council on Foreign Relations ahead of tonight's CNN interview with Vice President Harris. A preview up next.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Just a flavour of the scores for you. Equity futures positive by 0.2% on the S&P, up by 0.1 on the Nasdaq 100. We're doing okay. 2 hours out from the opening bell, 1 hour away from jobless claims in America. Nvidia, just to check in on the stock just briefly, and then we'll come back to it. We're down about 4%. in pre-market trading. In the bond market, 2-year, 10-year, 30-year, your 2-year, the front end of the curve looks like this, 385.88, yield just about unchanged. We work our way further out along the yield curve. We've gone from 2s to 5s. Is it 7s today?
Yeah.
Is that right?
$44 billion of 7-year notes. Yesterday's 5-year auction was interesting because it was pretty strong in terms of some of the dynamics, and yet it tailed, which meant that the yields came in at higher than where they were when it first initially priced. To me, this is interesting because, again, it goes to the dynamic we were talking about. On the front end, very strong, very clear demand, very clear faith that the Federal Reserve is going to cut rates. Longer end, more uncertainty, particularly when it comes to fiscal trajectory and what exactly is going to affect the buyer base.
You've been saying this all week, that the test gets harder, the bar gets higher as you work your way out along the curve. So we've gone from 2s to 5s and 7s later. We had a series of guests yesterday pushing back on extended duration as well. Charles Schwab's Colin Martin coming out and saying the Treasury yield plunge makes extending duration less attractive for them. And then we heard from BlackRock's David Rogel on this program as well, and we had a conversation about the fiscal deficit. We don't want to extend duration too much given the fiscal outlook. So to your point, your view at the front end of the curve, very different to some of the debates, the conversations happening further out.
And just to the point, and I just hear Steve Eisman's voice, oh, the deficit, it's all the people who've worried for their whole lives. There is nuance here. It's not people who are saying that yields are going to blow out sky high and that you're going to see 6-7% 10-year Treasury yields because of the deficit. It's people saying on the margins, we don't understand what that risk premium should be or will be as a result of the fiscal deficit, the fiscal overhang. So why go that far out on the curve? It is a different argument than simply saying the sky's falling. These are not Chicken Littles. These are people who are saying realistically, are we really getting our bang for our buck?
Yeah, we're having a conversation about maybe 50 to 75 extra basis points, as opposed to Eurozone debt-style crisis.
Thank you.
Two different conversations, aren't they?
Yes.
Let's take it to the FX market just briefly. Take a look at foreign exchange. We'll talk about some of the data coming out of Europe and the Eurozone. 110.98, it's a break of 111, just a weaker euro, just a touch. I've talked about this a few times already this morning. The breakdown of Eurozone CPI. We had the German breakdown, regional stuff. You get these German regions coming out with their individual reads on inflation, just a little bit lower than where we were in the previous month, indicating we could get some more rate cuts from the ECB. But the conversation we had earlier with Terry Wiseman, really building on the debate of the moment, I think, in foreign exchange. If you can normalize interest rates in America, if we can narrow so-called rate differentials, is that sufficient to unlock some real dollar weakness? The additional point here, the missing ingredient, in his mind at least, is that you need to really rebalance growth differentials as well. And from his perspective, he was making the argument, story in China, not great, saw some downgrades from UBS actually around GDP targets in the last 12 hours or so. Europe, not great, Germany's got difficulties. Now even in the UK, there's a prospect of a really tough budget coming up later on this year too, which would put additional pressure on the Bank of England to reduce interest rates. So it's just hard to make that argument that we're going to get that big bout of dollar weakness, at least from Terry's perspective.
Not only do you have potential growth concerns, but there also is this question, where does the next central bank surprise come from? What's priced in right now is a Fed that's poised to move at least 3 times, and an ECB, we're not sure. Because of the growth differentials, he sees a greater likelihood that the ECB could match what the Fed is doing. So he doesn't see any kind of massive surprise on that front either. If anything, more to euro weakness side.
I do have some sympathy with the view, though, that we have built up this massive long dollar position from investors outside of America reaching for yields, and that's pretty deeply entrenched. The yield available in America over the last few years, just totally unavailable compared to what you could get elsewhere.
I'm watching gold. I think it's the preview to a movie that's relevant here.
Yeah, was dollar yen the tremor and not the earthquake? You know, I'd ask that as well.
You know, but even Terry Wiseman, who doesn't see that happening right now, so it's a really important point. And he's bullish on gold, and he's watching this too to understand the flows. It just hasn't happened yet, but it doesn't mean it's not going to, so stay tuned.
We can get so bearish so quickly on this program. Dollar yen 144.62. AMH needs to come back and sort of rebalance this out.
Oh yeah, oh yeah. She's just Miss Sunshine over there.
144.60. She is right now. She's on vacation. Under surveillance this morning, a revenue beat isn't enough for NVIDIA. The chip maker failing to live up to investors' high hopes, delivering an underwhelming forecast and reporting production snags for its advanced Blackwell chips. The stock is down by 4%. Mandeep Singh of Bloomberg Intelligence with us just moments ago, really highlighting margins as a key issue going forward.
That was actually fascinating to me, this idea that the suppliers, the TSMCs of the world, are saying, hey, NVIDIA, you've got plenty of cash. Why don't you spend more of it on the stuff that we're providing to you? At the same time that NVIDIA is getting pushback from some of the end consumers in terms of how much they are willing to spend and face off with price increases, that margin compression starts to eat away at some of their incredible moat of competitive edge and their ability to keep rising prices and margins ad infinitum.
Dan Ives of Wedbush expecting this stock to be positive by the end of the session?
You know, he could be right, because how many people out there are saying they're waiting for a dip to buy? Is this a viable dip at a certain point?
It's not always the case. They wait for the dip, they get the dip, and then they fear about the next 5% moving in the wrong direction too.
What counts as a dip?
It's always the same.
What's a dip?
For this name?
This
Given
is a
the
dip.
price action on this name?
Exactly.
I don't know if this is. Maybe it's 10, 15%.
Right, exactly.
You know, in a couple of days.
Yes. No, this is the issue.
You know. Anyway, let's turn to the latest from the White House. National Security Advisor Jake Sullivan wrapping up a 3-day trip to China, meeting with President Xi Jinping as both sides look to stabilize relations. The Biden administration announcing an upcoming phone call between the president and his Chinese counterpart in the, quote, near future. Jake Sullivan's been given quite an audience, you know, in the last couple of days, meeting some very high-profile figures.
Which I thought was the most interesting aspect of this. He's going it over at a time where you have a lame duck president, and he's been given a very high audience at a time of a lot of international stress. I wonder how much the discussion is, hey, if you make things easier with Russia and Ukraine, solve some of these problems, then it's likely that you'll have Kamala Harris over Donald Trump. But there's a real question here in my mind, which is, which would Xi Jinping prefer? Honestly, it's unclear in terms of who he wants his dance party to be come January.
They've got some growth issues as well. They've got their own problems. We've talked about this repeatedly. Domestically, Europe and China have their own problems, and you can make the case that Europe is just a derivative of what's happening in China. I mentioned the UBS forecast, so they've now got GDP in China of 4.6% this year, compared to an earlier forecast of 4.9. For 2025, so a year out, UBS now seeing growth at 4%, down from 4.6% previously, and that's the direction of travel for a lot of economists looking at this economy.
So does China try to create better relations in order to be able to export more goods to juice the economy? Or do they become more hardline and go to some more sort of ideological policies and just steer clear of any kind of economic projections? I don't have a clear sense.
Or as some banks have suggested, maybe they're saving some fiscal firepower to see what the outcome of the November election is and what they might have to spend in 2025 to really cushion the economy. Let's talk about the politics. Kamala Harris and Tim Walz sitting down with CNN this afternoon. Top of mind, policy. Heidi Kriber-Redeker of the Council on Foreign Relations saying it's likelier than not that a Harris White House would build out foreign policy with a focus on international leadership, nurturing ties with allies and partners, including NATO, new minilaterals like trilateral with Japan and Korea, and critical minerals partnerships, and the G7. Heidi Kriber-Redeker of the Council on Foreign Relations joins us now. Heidi, let's build on that if we can, and welcome back to the program. Can I start with this one? You're incredibly well connected in Washington, D.C. I'll say that for you. How much daylight is there between Harris and Biden?
Well, I think you're likely to see quite a bit of continuation in the foreign policy agenda of a Harris presidency. And I think probably the most important area would be the relationship with allies and partners, because Trump has really shown that he's a go-it-alone president. And so, you know, in this day and age, the world is far more complicated than when Trump was president. You have an alignment with China, Russia, Iran, and North Korea in a world where America really needs to lead, but we have to do it with friends and partners, and that includes bolstering supply chains and resilience. You can't do that alone. So I think, you know, it just in the broadest sense, you would see a continuation of many of the features you've seen in Biden.
Heidi, when it comes to China specifically and the issues in China, do you think they can make the case that a multilateral approach has been more effective in the last few years than what we saw under President Trump?
Absolutely. I mean, I think, you know, you do have a more complicated geopolitical backdrop where you have China actually helping Russia's war economy, where you have much more cooperation across, as I mentioned, those four key countries who are geopolitical rivals right now. And so you need to have friends, you need to have allies, you need to have doubling down on the existing minilaterals, the new minilateral between the U.S., Japan, Korea, building on the Quad relationship with Australia, Japan, India, and the United States, and also building out the critical minerals partnerships and what we're going to need for energy transition and for defense. And I think also the traditional forums like the G7 take a lot of work, they take a lot of nurturing, and we did not see that during the Trump administration.
Heidi, we were just talking about how unusual it is that Jake Sullivan went to China and got such a high audience at a time where Joe Biden is a lame duck president, and there's a lot of questions around who's actually going to be the head of this country come early next year. Heidi, why do you think he went now and got such an audience?
Well, I think it's important to make sure that there is a channel of communication when there is any change, when there is uncertainty, which is running pretty rampant in the global geopolitical space right now, as well as in the global economic space. So knowing directly from the National Security Advisor what is the likely Harris agenda, what is coming potentially down the pike before the election or after the election with regard to any rumored expansion of export controls, how to manage competition in a way that sustains sort of strategic balance and safety. We have had a number of run-ins with China in the South China Seas and trying to make sure that we don't have any unintended consequences from some of China's more aggressive military actions of late. So I think just maintaining a senior dialogue at this critical juncture is crucial.
Heidi, I think that a lot of people are going to be watching tonight when we hear the first televised interview with a major media outlet of Kamala Harris and her running mate, Tim Walz. And I'm wondering, I'm sure China will also be watching to understand exactly what some of these policies may be, as well as many other international partners of the United States. Heidi, what are you expecting to hear tonight or not? Does it matter if we hear nothing in terms of policy?
So I think this is about politics as well as policy. We're 70 odd days out. Harris is sitting on momentum. She said she'd do an interview before the end of the month. And I don't expect her to really break any new news in this interview, but I think it's an important one to watch. And you are absolutely right. Everybody outside of the U.S. will be watching this to see if, for any policy insights. And I think this has been a sort of a policy light campaign on both sides. You have, Trump has had this Project 25, outside tomes made by others and not himself on many issues. And then, she's is the first candidate to be light on specifics. I mean, Bill Clinton was criticized for far too little on specific policy issues. And then Secretary Clinton, when she ran for president, was far too specific, and so I think at this stage in the game, we're close. We're really close to Election Day. She has an advantage. Harris has an advantage that she did not have to go through a primary process. She did not have to define her views and take some harder policy positions. So she has this advantage right now, and I think she's not going to squander it. So. And I think I like the fact that she's doing it together with Governor Walz. I think this is going to be an attempt to really show their personalities, human side, the way they interact. And he also gives her the out of not getting cornered by somebody, not pointing fingers, but looking at a press desperate to figure out specifics. She's going to try not to get cornered, and I think that's smart.
Heidi, you said that a lot of people are watching internationally in terms of trying to understand what a Harris presidency would look like. Do you think it will bother them if they get no specifics?
I don't think so. I think she wants to win. I think that there's been a lot of criticism of not having drilled down on specifics. And I don't really think that she's trying to play to an international audience in this interview. I think this is really a chance for her to talk to the American people and to voters. And so you might hear less on international and maybe more on domestic and what she and Governor Walz would mean for some of her domestic economic agenda items.
Heidi, we've got to leave it there. Come back soon. It's been too long. It's good to catch up. Heidi Krieber-Redeker there of the Council on Foreign Relations. Certainly for domestic consumption later on this afternoon, as it should be.
Well, sure, except is domestic consumption challenging Kamala Harris with respect to policies, or is it just media members who would like some more specifics so that they can analyze them as well as people in the market? It's a good question, and we've gotten conflicting remarks on.
You can see Republicans are really frustrated with this, but they're really frustrated with it because it's working.
Correct.
It's working.
And that's why Heidi was just saying, essentially, do no harm. Why should she do anything other than evade, not break any news, show a human side, have her camaraderie with Tim Walz kind of dominate all the headlines, and then move on?
Look out for clips from that in the next 24 hours or so. Let's give an update on stories elsewhere this morning. Here's your Bloomberg brief. Toyota sales eking out a gain for the first time in 6 months on strong demand in Europe and Japan as it faces recall issues in the US. The outlook for the current month appearing gloomy as a typhoon shut down all of its Japanese plants this week. Elsewhere, shares of Dollar General tumbling in the pre-market. The discount retailer cutting its full-year sales forecast, a sign that its turnaround efforts may not be doing enough to fend off competition. We are down in the pre-market, not a typo, down 23.4%. And finally, shares of Best Buy up in the pre-market, the company raising its annual profit guidance in a sign the demand for electronics and appliances could be improving. Best Buy saying they, quote, capitalized on the demand driven by customers' desire to replace or upgrade their products combined with new innovation. That stock is up 7%. And that is another example, Lisa, of the contradictory signals in retail in America.
That's exactly what I was thinking. And can you extrapolate out and say that Best Buy is more discretionary spending for people who are middle to upper income, and that Dollar General is more catering to lower income individuals, and they tend to be feeling the crimp of this economic moment more than others? I'm reading through. It looks like it could be idiosyncratic, a word that I dislike, but it's exactly the point that sticks out to me. Pick your poison. You've got a different story, and that's been for earnings, and that's been for economic data.
It's been the buzzword of the retail earnings season. Idiosyncratic. We've heard it on repeat. Up next on the program, all eyes on the labor market.
I'm not saying that the unemployment rate is going to go into the 5s, but it certainly is pointing to a deterioration and a direction that would suggest a higher unemployment rate.
Just published in Citi, Andrew Holdenhorst, what would cause the Fed to cut 50 if the unemployment rate remains at 4.3 as they project? The Fed will cut 50, or is likely to. If the unemployment rate falls to 4.2%, the Fed might only cut 25 unless payroll growth is also soft. More on that in just a moment. From New York, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities near all-time, or rather session highs, but still very close to all-time highs. What are we, 2% away?
Yeah, we've been 2% away for a while.
Something like that.
It's
all right, get ahead of myself. Give me a break.
It's okay. Wait
Up a third of 1%. And it's session highs on the S&P 500. In the bond market, 382.73 on a 10-year. Foreign exchange, stronger dollar today. 5 weeks of dollar weakness. This could have been week 6. We're about to snap that based on the price action of the last few days. Euro dollar 110.99. Under surveillance this morning, all eyes on the labour market.
There's been a deterioration in the labor market in the U.S. It seems to be evident in the data that started to come out in the latter part of the second quarter. It has continued into the third quarter. Now, I'm not saying that the unemployment rate is going to go into the 5s, but it certainly is pointing to a deterioration and a direction that would suggest a higher unemployment rate.
So here's the latest. Weekly jobless claims set to provide the latest read on the U.S. economy in just over 30 minutes' time. Lydia Bassot of EY writing the following: unless labour conditions deteriorate materially in the coming weeks, we continue to expect a majority of policymakers will favour a 25 basis point cut in September. We foresee 25 basis point rate cuts in September, November and December. Lydia's with us for more. Lydia, welcome to the programme. I just want to build on some of that, the kind of numbers that would be required, a prerequisite, if you will, for a 50 basis point cut on September 18th. What would you need to see today, this morning, and again on September 6th?
Good morning. So, I mean, in terms of what we would need to see for that 50 basis point rate cut to be on the table, you would need to see a continued deterioration in labor market conditions. When we look at the jobs report for August, job gain below 100, and a continued uptrend in the unemployment rate would likely put that 50 basis point rate cut on the table. We will also need to look at other labor market indicator. I think the focus is going to be on the jobs report, but the Fed is going to be looking at the totality of data. They're going to be looking at the JOLTS data as well. If we were to see that material deterioration in the labor market materializing, I think that would put that 50 basis point on the table. At the same time, we know that some Fed officials are more reluctant to go with, bigger rate cuts. We know that, there is a divergence of views with some Fed officials favoring more easing. We know that a 25 basis point rate cut was on the table at the July meeting. So I think what you're likely to see is the consensus converging towards that 25 basis point rate cut in September.
Let's sit on consensus. The median estimate in our survey for payrolls is 160. We've only got 7 estimates so far. That number could shift, things could change. But Lydia, let's go with 160. Given the recent revisions, shouldn't I just chop off 70 from whatever the number is and go with that?
The revisions that we've seen, over the past, over last week, and the revisions showed essentially that job growth was softer than expected, but job growth was still positive, and I think that's important to remember. We're still in an environment where the labor market is not retrenching. We've seen a slowdown in labor market gains, and what we have to keep in mind is that this slowdown has been playing out for a number of months. We've seen that gradual slowdown in job growth. We've seen, the moderation in job openings. We've seen less labor market churns, and most of the labor market indicators have been pointing to this gradual softening in labor market conditions. I think the key question is whether we continue to see that gradual softening in labor market conditions, or if something more serious materializes. And so we'll be, looking at that, and if we were to see that playing out, that's going to lead the Federal Reserve to consider a faster pace of tightening. But given the current conditions that we're looking at today, which is still a gradual deterioration in labor market conditions, but an economy that's still showing resilience, I think the Federal Reserve is going to err on the side of caution and go with 25 basis points at the next few meetings.
Just quickly here, we just have about a minute left, Lydia. How concerned are you about the "this time is different" moniker that people are talking about, given the fact that what we're now pricing in is something that historically is an anomaly?
Yes, the Fed has been, lucky enough to have that combination of resilient economic activity and bring inflation closer to the 2% target without inflicting too much pain to the labor market. I think what's encouraging is that we're now seeing the Fed ready to lean against that labor market risk. We've heard it last week with Fed Chair Powell mentioning the fact that there is ample room for policy to respond in the event of a material deterioration in labor market condition. So that's going to be very important. The Fed essentially showing willingness to lean against that labor market risk.
Lydia, we've got to leave it there. Lydia Basseur of EY ahead of jobless claims later this morning. About 35 minutes away now, Lisa, the next big stop for this market.
Yeah, and I wonder how much people are actually watching this or whether people have just seen it remain stagnant for quite a while. What do you think would be a bigger surprise, upside or downside?
That's unfair. For this market right now?
Yeah, what do you think?
What would freak it out more?
Yeah.
I think a big upside surprise.
You think so?
Oh, yeah, the kind of weakness that would change the conversation.
Yeah,
that's what we got August 2nd,
yeah,
right?
I think you're right.
Like, that's a guess.
Yeah,
that's a guess.
It's weakness, it's not strength.
Don't get me into trouble. I thought good news was good news and bad is bad. Aren't we rolling with that?
Maybe.
Okay. Coming up on the programme, Anastasia Amoroso of iCapital, William Stein of Truist, Michael Pugliese of Wells Fargo, and Earl Davis of BMO.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the parties. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We are in a fairly sweet spot that's been priced decently into the market.
This is an environment where you have to look at the fundamentals.
I think investors should go into a more diversified, multi-sector approach.
This market is driven by fundamentals, and it's not a gimmicky rally.
We're still having the mother of all debates between the bulls and the bears.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Things are a little bit calmer. 30 minutes away from jobless claims, 90 minutes away from the opening bell. Equity futures are positive by 0.25% and near session highs. On the Nasdaq 100 up by, let's call it 0.25%. With Nvidia in early trading, erasing yesterday's afternoon's losses, that's for sure. Negative by 3.4%, but still plenty of conversations, Lisa, about supply-side difficulties and what may or may not happen further down the line on the demand side.
What I find interesting is this is a tempered and rational market. People who are expecting that 10% move, although we can see there is quite a bit of volatility still in Nvidia, just to me the fact is people are looking at pricing out multiples. This is not about a wholesale fear or Armageddon or a broader commentary on market, which is the reason why you're seeing calm this morning, even with Nvidia failing to blow expectations out of the water.
Not exactly a great read on the economy either, given how many times we're told this is like the secular growth theme of the moment. So let's talk about the economy. Jobless claims 232,000 is the number that we're looking for a little bit later this morning, bang in line with what we heard the previous week of 232. Now, we've all got the same question. What would it take for this Federal Reserve to go with a 50 basis point rate cut on September 18th versus, say, 25? Well, I can show you the estimates for payrolls next month. Payrolls next month is about 160 on headline, and we're actually looking for unemployment to come back from 4.3 to 4.2. That's the median estimate so far. Andrew Hornhorst's City just published moments ago. He said you stay at 4.3, they go 50. You drop to 4.2, more likely to go 25.
That scenario would be supportive of what we're seeing right now in markets, which is the Fed would go potentially more significantly even without some sort of dramatic downturn. That, to me, is the real big question. You could make the argument about 25 to 50, but to me, it's sort of what do risk assets do with these rate cuts? What do risk assets do with an economic backdrop that people are just assuming will be benign? To me, it's less about the Fed's trajectory at this point and more whether there'll be good cuts or bad cuts to a market that is very much hedged to a soft landing.
It's bad news, bad news. You know, I asked the question about 15 minutes ago, and I know it's a little bit snarky. Do you think there will be some people that just take whatever the payrolls number is and just drop 60 or 70,000 jobs off it because of the revisions we've had over the previous year? Why wouldn't you?
I think that that's actually completely legitimate, especially because there was actually a story out in the Bloomberg this morning talking about how regional Fed surveys are starting to show some real risks to the U.S. job market. So the peripheral commentary highlights some of this weakness in a way that makes people wonder how accurate some of these surveys are, especially because response rates haven't been as great.
Yeah, this is the bias, I think, at the moment. You see a strong number. Is it strong? You see a weak number, must be really weak. And that's going to be the fear going into payrolls.
Which is the reason why, to your point, I very much agree with you that an upside surprise, a significant upside surprise to jobless claims would very much have a disproportionately large influence and a negative one on equities and other risk assets than, say, a lower than expected number where people could just shrug it off and say, well, you know, these are noisy numbers.
Equities right now, positive, 0.25%. All of that still to come. The number drops in 26 minutes' time. Outside of equities, into the bond market, Lisa's going through some of the supply we've had through the week. The 2-year went okay. The 5-year a little bit softer, relatively speaking. A 7-year auction, Lisa, later today.
$44 billion worth. We'll check it out and see whether we see the same kind of just general softening around the margins. Not trying to paint this with overly dramatic overtones. The point to me really is you get the sense people are willing to move out the curve 3 to 5 years. Are they willing to go beyond that given some of the other concerns and the fact that we haven't gotten an answer from Fed officials or anyone else about what the neutral rate actually is. Where is the stopping point here?
Yeah, not just the concerns about the fiscal deficit, but also the rally that we've already seen at the longer end of the curve. And the argument that we heard just yesterday, that you need the curve to normalize to really unlock that cash at the front end of the curve. You've got to incentivize them to go out along the curve with a high yield. That's the view we've heard from a few people on this program. Was it BlackRock yesterday that made that point? I think it was.
And Charles Schwab, this idea that he really enjoyed 10-year yields at 4.2% and 3.8%. Maybe you can hold it for the carry, but it's not going to have the same kind of massive price appreciations just given where we are.
The 10-year right now, 382.73. Coming up this hour, we'll speak to Anastasia Amoroso of iCapital as investors reassess the AI frenzy post-NVIDIA earnings. William Stein of Truist on why he's still bullish on the chip giant, and Michael Pugliese of Wells Fargo on why the worst is yet to come for the labor market. We begin with the big issue, the make or break moment that was just a little bit more break than make. NVIDIA disappointing investors with a weaker than expected revenue forecast, dampening the outlook for tech stocks as investors begin to question how long the AI party will last. Anastasia Amoroso of iCapital is with us for more. Anastasia, get super tactical, short term if you want to. Is this a buying opportunity for you? Is this some weakness you'd lean into?
I think it is weakness to lead into in the semiconductor space. I mean, John, it's interesting that you talked about this being maybe a break moment for NVIDIA. I probably wouldn't characterize it as such. I think it was a strong earnings report, but against very elevated expectations. What investors have gotten used to is that NVIDIA delivers blowout earnings reports and then overnight follows a slew of analyst upgrades to the stock prices, and that's what drive it higher. That's not what we got. We got a small, modest beat and raise quarter, and it didn't have the follow through that you typically have in terms of upgrades. So that's why it's called a disappointment, but it's a disappointment relative to very high expectations. But when you take a step back from that and you say, does this mean the AI investment cycle is not happening? You know, does this mean the economy outside of NVIDIA is weak? And the answer to both of those things is no. The AI cycle is absolutely happening. And it's not just NVIDIA that's participating, by the way, in the AI CapEx cycle. It's a lot of other companies. And we've heard from the likes of AMD and Taiwan Semis that this trend is still very much ongoing. We've heard that hyperscalers are investing and sizing up their investments in AI CapEx. So this is why, John, I would use this moment of weakness, by the way, I think about 50-day moving average, to step in and add to this important trade.
You talked about some of the chip makers, and then you talked about some of the customers. Can we sit on the customers? Do you think they need to demonstrate in a much bigger way in the coming quarters a bigger return on investment, given this big ramp up in CapEx we've seen over the last year?
Well, I think they do. I think that's why when I think about what places of the AI trade I would be buying, I don't actually lead with some of these hyperscalers because it's exactly right. They're going to be the ones that are outlaying the cash in order to make this investment. And the return on investment may follow, but with a lag. Now, you can't carry this forward and say, well, does the second derivative mean that they will slow down the investment and that's going to adversely impact the semiconductor chips? And I think the answer to that is no, because as we've heard from the likes of Meta, is that the hyperscalers would rather over-invest right now, waiting for that return on investment. So I think that's an important distinction, and that's why I very selectively say I would step in and buy the semiconductor space, because I think they're going to continue to benefit from this investment cycle. And John, just another nuance there. There's the AI trade within semis, but there's also the broader cyclical uptick in units sold in semiconductors. For the last year or 2 years, we were running at negative year-over-year numbers in terms of unit revenue, but we just flipped into year-over-year positive territory. And I think there's more to that. And we've also heard from other semis this reporting season that they have seen some demand uptick in auto and industrials and other sectors. So that's why I like this combination of AI still very much intact, but also potential for cyclical pickup in semis to continue.
Anastasia, so deliberate in your words. The idea when John asked, is this to buy the weakness for NVIDIA? You said, yes, you need to buy the semiconductor space. I'm just wondering whether this is really a moment where the high flyers, the ones that you're not as interested in getting involved with, or that you will be sort of holding, but not necessarily adding to the hyperscalers or the NVIDIAs of the world, whether that trade I don't want to say is over, but it's sort of seen its biggest gains. And now it's really the broadening out that so many people have been waiting for, the people who are using the technology, the suppliers to, say, NVIDIA, that are able to raise their prices because NVIDIA has so much cash that they can keep unleashing. Is that kind of the way you look at this trade now?
That's right, Lisa. I think we have seen the bulk of the earnings surprises for some of the mega cap companies. And if you look over the last year and a half, that's what's really driven their performance, just the magnitude of their surprises, where nothing else was really surprising to the upside. But as we look towards the year, and by the way, as we look at this earnings season, we saw the companies outside of the Magnificent Seven delivered earnings that were double what the forecasts were. They delivered something like 9% year-over-year earnings growth versus 4% that was expected. So that's why I do expect more market-type performance from some of these hyperscalers. But I do agree that looking within the supply chain, and by the way, a lot of the analyst notes that came out following NVIDIA were talking about the positive read-throughs to the tech ecosystem. So that's where you have to look, is within the hardware, within the optical equipment, within the rest of the chip space. But the other point, Lisa, that you brought up too, is that there is a broadening out. As important as NVIDIA is, it is just not as important as it was, let's say, a year ago to the broader market, because we have seen stocks like utilities, for example, financials, regional banks, as well as small caps, hold up a lot better than the tech trade has. So that's where investors are really focusing on right now, is how do they position for the thing that we know is coming next month, which is the Fed delivering its first rate cut.
Anastasia, do you think that it's sort of a question mark as to why the Fed is suggesting a significant rate cutting cycle at a time where other companies that are more leveraged to the economy seem to be doing better? And we haven't really seen that weakness, even in what we're expecting to see in 19 minutes' time?
Well, the Fed has to look at the unemployment rate and inflation. And if they look at those two things, certainly the rate cutting cycle is warranted. Inflation has come down a long way. And of course, we get the core PC number. Tomorrow, we're looking for 2.6%. That is a far cry from where we were and very close to the Fed mandate level. And then if you look at the unemployment rate, there has been obviously weakening and loosening in the labor market. And probably the biggest takeaway from Jackson Hole for me last week was the fact that Fed Chair Powell is now not welcoming any further weakening in the labor market. So that actually provides even more potential support for equities, because it means that should we see further weakening, the Fed will be likely to step in and maybe do so in more full force. And Lisa, then the last, not official mandate, but also if you look at where the real Fed funds rate is, close to 3%, 2.75, it is well above and over what the neutral rate is. So the Fed has a lot of basis points of rate cuts to potentially work with. So why not start with some of them, given that they're actually fulfilling the mandate right now?
Anastasia, appreciate it. Anastasia Amoroso there of iCapital. Using this as a moment to lean into this weakness, just a little bit of weakness when it comes to the likes of NVIDIA. How many times have we heard this? The Powell shift, the Powell put is back. Neil Dutta, RenMac, said it repeatedly.
Yeah, well, I mean, this is basically what you're seeing priced into the market. What I also thought was interesting, what she just said, is the high flyers retaining their mantle as the high flyers. I don't want to say it's over, but it's getting there. And that's the reason why the broadening out trade is continuing to gain steam, even without the participation of NVIDIA. That, to me, is one of the question marks that I have. How much is that going to be the recognized idea that, the Magnificent Seven are not going to be the Magnificent Seven in the upcoming 12 months?
Jobless claims about 17 minutes away. That will build on some of the story, some of the things we're talking about here. 232 is the estimate in our survey the previous week, 232,000. Let's give you an update on stories elsewhere. Here's your Bloomberg brief. The FBI providing more information about the attempted assassination of former President Donald Trump. Officials saying the gunman had searched information about explosives over the last 5 years. Investigators have conducted nearly 1,000 interviews, but still do not have a motive for why the 20-year-old shot at the former president. The Netherlands planning to restrict ASML's ability to repair and maintain its semiconductor equipment in China. The decision coming after pressure from the US and is a potentially painful blow to China's efforts to develop a world-class chip industry. And finally, shares of Supermicro Computer falling in pre-market following yesterday's 19% plunge. The company saying it will delay filing its annual financial disclosures and will need additional time to assess its internal controls. We're down another 4%. Lisa, talk about red flags in the last 24 hours.
Well, yeah, especially after an activist investor went after them saying that they're not going to file their 10Ks after the Hindenburg report talking about how they were overstating certain aspects of their business. Not a great look, and the market's responding accordingly.
Yes, Sound now asks questions later,
exactly.
and hopefully get some answers. Up next on the program, the morning calls, lots of NVIDIA for you, plus William Stein of Truist, who's still bullish on that name. From New York City, this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
One hour, and let's call it 13 minutes away from the opening bell. Futures up by 0.2%. Just a little bit of a lift there on the S&P 500. Let's get to some morning calls for you with one stock in focus, NVIDIA. First up, JP Morgan raising its price target to 155 from 115 and keeping an overweight rating. The analyst saying the company maintains a 1 to 2 step lead ahead of competitors. Next up, Raymond James raising the chip maker's price target to 140 and maintaining a strong buy rating. The analyst noting that Blackwell delays seem better than feared. And finally, Wells Fargo raising its price target on NVIDIA to 165, keeping its overweight rating. The firm finding it hard to see negatives in earnings and guidance and recommending buying the pullback. The pullback, the size of it right now, we're down by almost 4%. Joining us now to discuss is William Stein of Truist, who has a buy rating on shares of NVIDIA. And William, you upgraded the price target going into the print and lifted a price target coming out of the print as well. What did you like coming out of those numbers just yesterday?
Sure. I mean, look, it's easy to look at the stock action, especially immediately following earnings, and say, oh, something's terrible here. It actually takes quite a bit of hunting to find the problems, right? They beat on revenue, they beat on earnings. They beat on revenue and earnings in the outlook as well. So if you're consistent in terms of applying a multiple to the stock, you'd be raising price targets here. So this is our checks revealed that demand was very good, and that's what actually came to fruition, and that resulted in this price target increase.
William, can you build on some of the supply difficulties, and then we can talk further down the road about potential demand problems? The supply difficulties, are you encouraged by the interview that we had with the CEO, Jensen Huang, sitting down with our colleague and good friend, Ed Ludlow, that ultimately supply is going to pick up and everything's going to be okay? Was that sufficient for you?
No, I think even the quarter was sufficient in this regard, right? So they announced that there was a mask change in Blackwell, and there's some debate as to whether this is really a delay or not. From my perspective, I don't consider it a delay. From my point of view, it's sort of similar to my telling you all that I'll show up at 8 o'clock, and I show up at 8 o'clock. The fact that I got up late, burned my breakfast, had to change my clothes twice, all that sort of, is in the background. If I show up on time, I show up on time. And I think that's exactly what's going on with Blackwell. It's still ramping in Q4. There's no revenue air pocket. Having to redo masks along the way is not some very unusual process. It's just, I think someone got wind of this. It wound up getting a lot of attention in the press. So management acknowledged it on the call. But I don't think this is some unusual consideration in semiconductor manufacturing, especially considering how sophisticated the processes are that NVIDIA is deploying.
Let's extend the metaphor. Let's say there is somebody who always wakes up on time, always has a perfect breakfast of a protein shake and an omelet, and always gets there at 7:55. And then suddenly this person burns his breakfast, wakes up late, and gets in just at 8 o'clock. People start to lose faith that they'll be able to keep showing up at 8 o'clock. And I think that is the fear with NVIDIA. How much can they depend on this company to continue outperforming at a time that they're facing off with new competitive landscapes, as well as higher input costs from the suppliers that are raising their prices?
I think that's an excellent follow-up question. Look, I don't think that there's a question about NVIDIA's ability to deliver. I don't think that's what's come into question here. Are the transitions from architecture to architecture going to be as smooth and flawless as perhaps Hopper was, or another one that went, perfectly well? They're not all going to be like that. I don't think it calls into question NVIDIA's ability to manage those transitions. They've done it many times in the past, and I think we have many more to come in the future. I don't think that's really the question. But I think the second part of your question is really the issue here, which is there seem to be some higher costs. And I think that's the effect that the mask change had. I think that's part of what's causing this gross margin degradation in Q3 outlook and the implied comments about Q4 gross margins. I think that relates to the Blackwell mask change, but also increasing input costs. And I think that is the one legitimate gripe about the quarter. If you're searching for the problem, you're searching for why the stock is down, it's the gross margin downtick in Q3 and then bigger downtick in Q4. And I think it relates to Blackwell, but it also relates to input costs. I think TSMC is probably trying to take a little bit more of the margin stack here. And high bandwidth memory is also a higher input cost as well. And I think those are the factors.
William, can we recast the move in markets? Let's say the bear is coming out of hiding and slamming this company, and more people wondering how long this company can keep performing just out of this world incredibly and continue having astronomical stock price increases. In other words, how do you justify a valuation at this level, given how much we've already priced in, and can they grow to that expectation? What gives you confidence that yes, they can and then some?
Sure. So this, I think, is relatively easy to answer. For very rapid growth stocks, we'd expect to see an even bigger multiple. People ask, is it priced for perfection? That's similar to what you're asking me. I think this is now trading below 40 times, certainly maybe 35, 36 times out year earnings. That is not a multiple that implies perfection and unbelievable growth. Are we seeing growth fade here? Certainly. They're not going to grow at 250% forever. They're not going to grow at 150% forever. A high double-digit growth rate is amazing for a company this large. And we think that is something that can persist over time. Let me take the other side of it, though. Is there going to be a period where they slow down and post negative year-over-year growth? With certainty, that is going to happen. We don't think it's going to happen in calendar 25, but it happened very recently before this big growth spurt started about a year ago, and it will absolutely happen again. We just don't think it's happening right now, and we think it's very easy to justify 40 times earnings for a stock growing at this pace and having this sort of forward look on their business in AI.
William, just finally, before you go, have you got a decent framework to help our audience, just a historical parallel for what you think this moment is like?
You know, that's tough for me. It's hard for me to tell you exactly what the parallel is. To me, this is just people over-interpreting the effect of a gross margin stutter step. We do think they'll work through that problem, and we think the revenue growth trajectory is very strong for this company. We would buy the weakness today.
William, thank you, sir, for showing up at 8 o'clock. Appreciate it. William Stein there at Truist, and I hope you didn't burn your toast. That's really important. Bramo, what did we hear from Dan Ives? Like gold rush moment?
Oh, yeah.
Yeah, that's what he thinks this is.
Yeah, Industrial Revolution.
Yeah, all of that.
The railroads.
That
talking
too.
about the advent of the telephone. Maybe an Edison moment of the
Internet.
light. Yeah. I mean, internet's almost like small potatoes. No, but truly, I mean, it's potentially going to revolutionize things. I really would like to get a better handle on exactly how. And I think a lot of other people would too.
Truist, buy the pullback. Wells Fargo, buy the pullback. We've heard this repeatedly. Raymond James, Blackwell delays better than feared. Buy the stock. JP Morgan, 1 to 2 steps ahead of competitors. Anastasia Amoroso, Y Capital, moments ago, buy the weakness.
Well, Anastasia Amoroso was buy the weakness, meaning buy the weakness in other companies related to the semiconductor trend. It wasn't necessarily buy NVIDIA. And that, I think, is important. How much do you need to see that broadening out to fuel the ongoing gains that we have seen in NVIDIA?
It was very, very specific.
Yes.
Coming up next, jobless claims just around the corner. We'll catch up with Mike Puglisi of Wells Fargo, Earl Davis of BMO, just around the corner to react. And Mike McKee will give you the numbers from New York. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
One hour away from the opening bell, equity futures up by, let's call it a third of 1% on the S&P 500, up a third on the Nasdaq 100. The next stop for this market, seconds away, 15 to be precise. Jobless claims just around the corner. Mike McKee's in the studio. He's ready to break this down. The scores in the bond market, 2-year, 10-year, 30-year, shaping up as follows. A 10-year at 383.30, a 2-year at around 386, 385, 88. With your data, here's Mike McKee. Good morning, Mike.
Well, we get a little bit of an improvement in jobless claims, 231,000. That's down from 233, the revised number from a week before. Continuing claims, 1,868,000. That's up just a little bit from 1,855 the week before. That's 2 weeks before, of course, with continuing claims. So at this point, what we're looking at is a jobs market that hasn't changed a whole lot. And that should give the Fed some reassurance. Other numbers out right now. GDP, the second revision, well, first revision, second output from GDP goes up, which is a bit of a surprise. It was expected to be unchanged at 2.8%. Instead, it's 3% as personal consumption. Americans are spending a lot more, goes up to 2.9% from 2.3%. A very interesting change there. The GDP price index, 2.5%. That's up from 2.3, and the core 2.8, down from 2.9. Probably those numbers aren't going to really affect the Fed since they were second quarter numbers. They are revisions, and tomorrow we'll get the numbers for July, which will give us the latest data overall.
Mike, put it all together. Growth decent, claims contained. That's a recipe right now, the ingredients for this market to look okay. Equities up 0.4% on the S&P 500. Good news is good news. Check out the Russell. At least the small caps up by 0.8%. That's where your outperformance is in the equity market. In the bond market, yields up 3 basis points at the front end of the curve, approaching 390 all over again. And just to exacerbate the trend of the morning so far, dollar strength, euro dollar down to 110.79.
Everything is awesome. I mean, look at this data. You've got disinflation, more disinflation than we thought when you look at the revisions to GDP and core PCE. Initial jobless claims come in bang on line, but when you take a look at continuing claims, they went down notably across the board. It was revised downward for the prior month in terms of continuing claims, basically in line previously. There is no sense that the economy is falling off a cliff or that the employment market is falling out of bed, which raises the specter of the right kind of Fed rate cuts that a lot of people are expecting.
We'll get another read on claims next week, going into the payrolls report for the month of August on September 6th. Mike, help us settle a debate here. I'm going to tee up 2 quotes, one from Morgan Stanley and another from Citi. And the debate is over the weather. Yes, really, the weather. Morgan Stanley are looking for 185 next week on payrolls, and they say in the weakness of the July jobs report, some was weather, some was noise, some was the slowing trend, but we expect a partial reversal in payrolls in August. Citi said this, Mike, the multi-month rise in the unemployment rate is not a weather-related distortion or the consequence of surging labor supply. It reflects a slowdown in hiring, which will likely continue and eventually worsen into outright layoffs. How do you view this weather debate?
It doesn't seem... There's a question about whether Hurricane Beryl in Texas affected the figures during the month of July. And generally, the BLS says it didn't. Generally, economists have come to the view that it probably didn't, but there could have been other weather effects because there was a large number of people who were off work because of weather who didn't show up in the jobs numbers from Texas. So there may have been other areas of the country where there were weather issues. The biggest issue is that there was a big rise in the number of people who were on temporary layoff, and that may have been connected to automobile retooling factories. We will see if that reverses. If that reverses, then we get a better number, and that's kind of what the consensus is looking at this point. But let me just say this. It doesn't matter. I mean, as long as we get a reasonable number, it's the unemployment rate that's going to matter to the Fed, and whether or not, and this gets back to what Morgan Stanley said, whether or not it's because if the unemployment rate goes up, it's because more people enter the labor force or because companies are starting to lay people off. And the claims numbers don't suggest we're seeing layoffs.
So John said something earlier, and I thought it was a really interesting point. It was an astute point that how much are people looking at this data and are going to be looking at the jobs number and just subtracting 60 or 70,000 from that, given where the revisions are. And I think that that's a valid point in a broader context as well. How reliable is data that is moving around a lot? I'm looking right now at personal consumption, the second revision of the second quarter results was revised to 2.9% from 2.2%. These are pretty big revisions for a second time around, and it's something that we've gotten used to pretty much across the board.
Well, they do their best, but the problem is that response rates have gone down, and the pandemic created unusual situations where we haven't seen data come in the way they used to do that. The BLS and the BEA are trying to change some of the statistical methods and get private sector data in to try to make this more accurate. The bottom line is the Fed has to deal with the numbers that it has, not the numbers that are eventually going to be revised. I don't think I would subtract 68,000 or whatever from the numbers, because that's based on what was happening through March of last year and March of this year, and we often see that revised again between August, when we got that number, and January, when they actually apply the figures, and it's usually revised lower. So 818,000 may turn into something lower than that. There's some, Goldman Sachs thinks it'll go down to 300,000.
So I should take off 90,000 on the payrolls report next week?
No, they think it'll only be 30,000, so you may take off 9,000 or something like that. Let me just mention here, profits.
You confused me, sir. I'm confused now.
I think it makes sense that they think that it's a smaller revision downward. Either way, we just have doubts about the numbers. That's the point. Carry on.
Profits, since we're all talking about NVIDIA and 50% margins isn't enough. Second quarter profits, this is the first time it comes out in the GDP numbers, up by 46.4 billion for domestic financial corporations. For regular corporations, profits up by 57.6 billion in the second quarter. That was a decline of 47.1 in the first quarter. So companies made more money. The economy was better. Companies made more money. This includes everybody, including private companies, not just public companies.
Mike, thank you. This is the data we've got. Let's start with jobless claims, 231. The estimate, 232. Previous week, revised 233. Jobless claims are contained. Equities off to the races again, up by 0.8%. On a Russell, the small caps outperform. On the S&P, up 1/3%. In the bond market, 2-year, 10-year, 30-year, yields creeping a little bit higher following that economic data across the curve. On a 2-year at the moment, 387.53, up a single basis point, 385 on 10s, up a basis point. Push that through foreign exchange. You have got a stronger dollar, a weaker euro, 108, or rather 110.85. 11085. We're negative by 1/3 of 1% on that currency pair. Joining us now to weigh in on the data, Michael Puglisi of Wells Fargo. Michael, your view on the jobs data so far. I think people can make the case that maybe payrolls have overestimated the strength of the economy. Can you make the case that claims understate the weakness? Because right now, 230, it's hard to make this stuff up. Jobless claims look pretty decent.
Yeah, the way I think about it, John, is there's clearly been a slowdown over the course of the past year or so, and you see this in all the labor market data. You see it in payrolls, you see it in the rising unemployment rate, you even see it in claims, which have ticked up some over the course of the year. But it's been orderly, right? It's been a gradual, orderly, and fairly controlled cooling in the labor market. And I think when I hear Fed Chair Powell and some others talk on the FOMC, their concern is any further weakness that starts to get a little more nonlinear, right? It's cooling gradually until very suddenly it's not. And so far, so good. I think we see that pretty much across the board, that gradual slowdown. But the worry is, what if it starts to become nonlinear in unemployment, in claims, and you see much broader layoffs than we've seen so far?
Michael, how reliable is this data? We were just talking about that with Mike McKee, this idea that we have seen some pretty big revisions. There are fewer respondents to some of these surveys, doing the best they can, but kind of getting messy.
Yeah, I mean, the data is certainly reliable. It's revised, and that's always been the case. So the revisions have gotten a little trickier post-pandemic for some of the seasonal related issues and pandemic-related issues Michael was talking about. But just more broadly, I think it's important not to miss the forest for the trees and what's happening on trend. We very well might get a bounce back from the very weak July numbers we got on NFP and then unemployment rate. Maybe it's weather, hurricane-related, maybe it's something else. But the trend is very clear here in payrolls, in the unemployment rate, even in the survey data. Look at the last consumer confidence report. More consumers reporting that jobs are scarce, fewer consumers reporting that jobs are plentiful. And when I look at the totality of the data there, I think that's very reliable. Even if week to week in claims or month to month on payrolls, you get this noise from a whole bunch of factors.
I guess there's this question also for people who are concerned about this time is different and that sort of existential fear that it never happens in a linear fashion, which you can really feel at the Federal Reserve. I just wonder going forward whether the strength that we're talking about when you add 200 basis points of rate cuts through the end of next year, whether we start to worry about a reacceleration in inflation again, or whether that's truly off the table, whether people really believe we are back to pre-pandemic norms.
Yeah, and that's the tightrope the Fed is trying to walk, right? It's ease enough to keep this expansion going, but not so much they find themselves back in the same problem that they had a year or 2 or 3 years ago, right? You heard Raphael Bostic highlighting that yesterday. In his view, he really doesn't want to be in a situation where they have to hike again. I don't think that's real likely. I mean, inflation's at 2.5% right now, and I think given the slowdown in demand we're seeing, that'll continue to decline for both bottoms-up and top-down reasons. But shocks happen, right? Geopolitical shocks happen. You get commodity price spikes. We've got an election coming up in a few months where maybe fiscal policy changes a whole lot in 25 and 26. So the Fed still has to be on guard, and I think that's why they want to proceed towards neutral, but not necessarily to accommodative Fed funds rates of 1-2% like you'd see in a recession.
Adam Posen has made the point in the Financial Times from the Peterson Institute, Michael, that maybe they should be prepared to pivot from the pivot if the former president gets another term because of issues around immigration, because of issues around tariffs as well. Do you think the political considerations are strong enough that that might outcome in 2025?
Well, I think what the FOMC is going to have to do is just wait to see what happens. When you go back to 2016 as an example and look at what they were talking about after that election at the December meeting that year, they weren't sure. They didn't know if we were going to get a lot of fiscal stimulus via tax cuts, and they didn't know what some of the policy changes were going to be, and so they had to proceed with some caution, and that's what you saw, and I think you would see something similar. I don't think you would see a kind of proactive knee-jerk response because there would be uncertainty about changes related to trade policy, tax policy, spending policy. But, for example, if you got a fiscal policy change, more spending, lower taxes that gave you faster economic growth and faster inflation, then I would expect a Fed response.
Michael, thank you, sir. Michael Puglisi of Wells Fargo on the latest. Adam Posen says don't wait. That doesn't mean act. It means start talking about it. He reflects on a period of time which was, I have to say, incredibly controversial at the Bank of England under Governor Carney, when Carney at the time weighed into the Brexit debate and said what it could mean for the supply side of the economy. And if I remember the language used correctly, it was something like the speed limit of the economy would shift, we'd be more prone to inflationary shocks because of the supply side issues. It was a view at the Bank of England that ultimately this could be a scenario, this is what we think about said scenario, this is our belief. Adam thinks the same thing should be happening at the Federal Reserve with regards to the politics of the next year or so. And like I say, that can be incredibly controversial because you're wading into a topic that there are a certain set of individuals just don't want you there at all.
There's a discussion, an economics discussion around tariffs that's not being had in open, where people really lay out exactly which tariffs could be potentially really negative. I mean, you are seeing it on the margins from certain think tanks and such, but not from Fed officials, because it becomes so political, and then they worry about political independence and fears of accusations on that front. Nonetheless, you have to imagine that in the Fed, in the regional Feds, certainly, they've got to be doing scenario analysis here because that will absolutely affect how they look at rate policy next year.
If you are just joining us, welcome to the program. Equity's doing okay, up 0.25% on the S&P 500. Some real outperformance on a Russell. The small caps up by 0.8%, something like that. If you look to the bond market, we look like this on a 2-year and a 10-year. Yields creeping a little bit higher, up by 2 basis points on 2s, on 10s, up by 3. All of this off the back of jobless claims coming in, basically in line at 231. The estimate was 232, and we said a meet is basically a beat for this market. This is what this market wants to see, just contained jobless claims.
Yeah, contained jobless claims and upgrades to the GDP revisions, as well as downgrades to the inflation reads from the second quarter. It basically is the perfect scenario. This is basically soft landing nirvana.
Oh, Davis of BMO joined us for more on that. Oh, Davis, unequivocally dovish, your view of Chairman Powell last week. It's time to go long anywhere on the curve. Oh, can you build on that? Why anywhere on the curve?
Because what we'll experience actually is going to be a bull steepener, which means, your 2 years will outperform your 10s and 30s. But it's actually our preference to go long 10s and 30s because the volatility in 10s and 30s will be lower. So from a Sharpe ratio or a risk-adjusted ratio, it makes more sense to go long 10s and 30s despite our steepening bias.
This time yesterday, we caught up with Charles Schwab, Colin Martin. He said the Treasury yield plunge more recently makes extending duration less attractive. Oh, how do you think about that, just the valuation proposition?
Yeah, you know what? I fully agree with that statement. That's why we're only, call it a 5 on 10 long the market. But the thing with this market, although valuations have gotten arguably ahead of themselves for now, you never know when the next spike lower will be. As I like to say, I've been in the market for 30 years, and you know what? If timing was my strongest suit, I wouldn't even be on the show right now. I'd be on the beach somewhere. But I always want to make sure I'm in the position I want to be. But we're looking towards 4%, where we really add to our longs and go full in long in 10-year yields.
You'd be calling us from the beach. I know, Earl. You'd be calling in. You'd be wanting to talk
to us. For what it's worth, Bramo, Earl, I wouldn't be here either. Right there with you.
All right, moving on. You said something that volatility is less in 10s and 30s, and that's one argument for going into them. Is that true? I mean, at a time when a lot of people are talking about a sort of new environment for yields more broadly, but especially duration, of more volatility there, especially with the election coming up.
Yeah, you know what? I didn't say there's going to be no volatility. There's going to be volatility everywhere. But this is why I love being an active manager. This is why it's perfect time to be in the shoes that we're in. We have our expectations. As I said, we do expect yields to go lower. But the market, we also expect it to go higher. But that allows us the opportunity to get long. This is the difference between passive and active. And it's the perfect time from an active manager perspective to monetize that volatility. And our team has been doing that for the past 2 years. You've heard us with the 2-year trade before. That was an example of volatility in the 2 years. Now we think we'll see it in 10 years and we can monetize it there.
Is there a contradiction in this bullishness across the curve in bond markets? Is there a contradiction with the strength of the economy that we're seeing?
No, there's no contradiction. Actually, it's very similar to the weather argument that you brought up before in regards to the employment number. I would expand that weather argument to the markets. There's so many credible, plausible outcomes in this market in regards to rates higher, rates lower. But this is why it's important from our perspective as an active manager. Don't get caught on where do you think rates will go, because you're going to miss the volatility, and that's where you can monetize. So I think all the arguments are credible. Our team, we have a process where, it's been validated in regards to outlooks and views, and that's why we do see lower rates from here. But it's not going to be a straight line lower as we're seeing. It would not surprise us if we see 4% 10-year yields, but we feel that's a level where you start backing up the truck.
You have made some assumptions about the destination for Fed funds, though, Earl, and it stood out for me after the Chairman Powell speech of Friday. You said once easing starts, you believe the target is neutral at a minimum. What is neutral to you, I guess, would be my question. What do you think the Fed thinks it is? And are we talking about 200 basis points of cuts over the next, 12 months, 18 months?
Yeah, it's a good question. I would argue that neutral to me doesn't count because I'm not the one doing the eases. So I try to listen to the Fed governor speak. We heard Hawker last week say it's 3%. I would say it's somewhere in and around 3%, which says there's 200 basis points of cuts coming over the next couple of years, all else equal. The market's only discounting 100 right now. That is why we saw the speech as unequivocally dovish. The path and timing to lower rates, that's the uncertain part, but we definitely see a move towards neutral. The interesting thing about this, there's 3 things we're looking at in the market that will add to volatility, impact our positioning. One is, as we've spoken about, the employment rate. We think that's very important. The second one's the election, and that will take on more and more, be more amplified as we get towards November. And then the third one, this is the important one, is those risk-off moments that could come from idiosyncratic actions, you know, the butterfly wings that starts a hurricane. So it's that third one. You know, neutral's 3%, but the Fed put is squarely on the table now. We saw talk of possible 50 in the market when we had the Japan sell-off. That hasn't gone away. So we like being long, we like seeing rates go to neutral, and now we think we have a free option on the Fed put, which could go way below neutral.
Oh, this was great. Appreciate it, sir. Oh, Davis there of BMO. You've earned a weekend on the beach. We shouldn't have favourites, but he's one of mine. Just brilliant.
100%. And I love the sort of scenario analysis that he has and sort of the range. 4% back up the truck.
Big time. The bond market today yields just a little bit higher, just a touch higher by a basis point or two across the curve. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. The US economy is holding up well. Jobless claims coming in at 231,000 for the past week, just a tick below estimates. GDP for the second quarter revised higher, partially reflecting an upward revision to consumer spending. Elsewhere, Chinese smartphone giant Huawei posting a sixth straight quarter of growth, the company gaining market share against one of its biggest competitors, Apple. Smartphone shipments jumping 50% in the June quarter, Apple dropping to 6th place in the Chinese market. And finally, shares of Salesforce rising in the pre-market, the company reporting a strong profit outlook. The maker of customer management software reporting second quarter results that beat expectations and offering a strong profit outlook. The stock is up by 4.5%. You're opening about 40 minutes away. Up next on the program, the calendar for the rest of this week. We'll catch up with Ed Ludlow following his exclusive conversation with the NVIDIA CEO.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The opening about 37 minutes away, equities improve, up a third of 1%, doing better on the small caps following better than expected numbers just moments ago on the US economy. Here's your trading diary, the calendar for the rest of this week. Pending home sales coming at 10 a.m. Eastern, plus Gap and Dow report earnings after the closing bell. Tomorrow, we'll get core PCE and UMich sentiment to close things out going into the weekend. For us right now, still digesting numbers from NVIDIA. The stock is down 3.2%. Ed Ludlow sat down with the CEO, Jensen Huang, in an exclusive conversation. Ed joins us now for more. Ed, walk us through your big takeaways, because yesterday when you were conducting that conversation, the stock was in a very different place.
Yeah.
Yeah, and I think that Mr. Wang was a little bit frustrated about that. You know, go and see the full interview, but at the beginning he literally just stops and cannot believe the decline because he felt that during the analyst call they'd explained the situation of next generation product quite clearly. But I think that's the main take, you know, that he tried to hit the market over the head with the idea that they made a commitment to bring a new chip to market every year. And Blackwell, the sort of minute focus of the street, is going fine. It will ramp in the fiscal fourth quarter. Supply is improving. And I think, you know, it's just a few words, but he said next year, as in next fiscal year, will be a great year. And I think that's got a lot of people a little calmer this morning in the markets.
There's also a question about the broadening out in potential buyer base, how dependent they are on a few names.
Yeah. There was some sort of thin evidence that their business, what they call sovereign AI, which is basically either selling directly to governments or to entities or regional units backed by government money. I think kind of like CHIPS Act money is picking up steam, high double-digit billions of revenue in this current fiscal year. I still get the sense that the data center operators are the story still.
Ed Ludlow, fantastic coverage in the last 24 hours. Congratulations, buddy. Ed leading our coverage on the West Coast following that conversation with Jensen Huang, the CEO of NVIDIA. Very different place yesterday afternoon compared to where we are this morning, going into the opening bell.
It's barely down, and if you listen to Dan Ives, it'll be up by the end of the day. To me, the frustration was really interesting, and it's sort of, you know, we delivered everything to you on a silver spoon. We thought we explained to you why we did what we did with Blackwell, that it's coming out, it's still you're down. To me, the real question is going to be margins, and I think that that's what a lot of people are picking up on, and that's where the questions will remain.
Stock is down 3%. More from Ed and the team on that exclusive conversation later on this morning, 11 o'clock Eastern Time, alongside Caroline Hyde, Bloomberg Technology. If you want to catch the full interview, you can find it on Bloomberg.com and on the Bloomberg terminal. Coming up tomorrow, Jonathan Stubbs of Berenberg, Helene Becker of TD Cowen, Claudia Sam of New Century Advisors, and Dana Telsey of the Telsey Advisory Group. From New York City, thank you for choosing Bloomberg TV. That does it for us. Good luck for the rest of the trading day. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest. And whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything.
Futures regained their footing after NVIDIA's rocky reception yesterday. 30 minutes until the official start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, NVIDIA pays the price for lofty expectations. CEO Jensen Huang tries to boost confidence in an exclusive Bloomberg interview. Meanwhile, OpenAI close to raising money that would value the startup at more than $100 billion. At what point are they not a startup anymore? We'll discuss. And with earnings season coming to an end, the focus is turning back to the macro landscape. Fresh data out this morning showed that the economy still holding strong. Let's take a look at where markets are trading about 30 minutes until the start of trading. You can see actually a little bit of green on the screen, which is difficult to believe with NVIDIA down by more than 3% right now. But the S&P 500, the NASDAQ 100 up about 0.3% in the pre-market. Meanwhile, the bond market right now, that 10-year yield higher by about 3 basis points, Sonali.
That NVIDIA fallout is going to be the big story of today because it failed to live up to investor hopes with its latest results. And shareholders are on edge after an underwhelming forecast and news of production snags. NVIDIA down pre-market about 3.4%. We'll keep an eye on the sector throughout this show. Best Buy also reported earnings. It raised its annual profit outlook in a sign of stronger demand for its products. And you have Best Buy just soaring on the morning, up almost 16% this morning. But a different story for Dollar General, which cut its full-year sales forecast as it struggles to fend off competition during a turnaround phase, and Dollar General just tanking more than 25%, almost 26% lower pre-market, Katie.
So a lot of action under the surface, and also we should take a look at the economic landscape because we did get some eco data. You take a look at GDP quarter over quarter coming in at about 3%, higher than estimates of 2.8%. You take a look at personal consumption also coming in a little higher than expected as well. Maybe softening the blow from what we saw, blunting the impact of what's going on in NVIDIA right now.
And there could be another reason here, Katie, that the NVIDIA downturn here, or at least in its stock, is really muted when you look at the overall market. It's options. If you think about it, Bloomberg News reporting that they represent more than 20% of the overall S&P single stock options notionally traded, but that 20% is still far less than the 50% or more in May and June. So a lot less interest in what the derivatives look like under the surface with this stock.
Yeah, big time. Could, of course, help to explain why you do see the broader market being pretty resilient right now. Definitely hasn't been the case in the past. But let's talk about what we actually heard from the company, because yesterday, Bloomberg Technologies' Ed Ludlow spoke with NVIDIA CEO Jensen Huang about the supply for its next generation chips.
We're expecting Q3 to have more supply than Q2. We're expecting Q4 to have more supply than Q3, and we're expecting Q1 to have more supply than Q4. And so I think our supply condition going into next year will be a large improvement over this last year.
We're going to bring in Bloomberg Technologies' Ed Ludlow, now in San Francisco, of course, with that conversation last night. At the end of the day, the numbers were fine, and the outlook here was even a little better for some products, Blackwell than expected, perhaps. But why are investors so muted at the end of the day?
Yeah, I mean, this morning, a pre-market decline of like 3%. I guess we should ask the question of whether we've gone to kind of a sell the news event rather than a macro level disaster or disappointment, because it's very different to what happened in real time. And what's so interesting about the soundbite you played from Jensen Huang is that the moment the analyst call ended, the stock actually accelerated declines in the aftermarket because everyone was exasperated. They were like, come on, give us some granular detail about Blackwell. Tell us something that gives us hope for our models, because some of the higher range models for the fiscal third and through the end of the year were a bit nuts, to be honest. But for me, that's the takeaway from the interview, right? He was combative and defensive and basically said, I cannot believe this because I thought I'd done a good job of explaining what's going on with this next generation key product.
Yeah, and I'm glad that you spent a lot of time on Blackwell, of course, and that was the headline of the write-up from that interview, that basically Jensen Huang saying that we're going to have lots and lots of supply. We will be able to ramp. But sort of zoom out for us, Ed. What benefits and what advantages does Blackwell have over the current chip, the Hopper right now? Yeah, performance essentially, energy efficiency, the number of computations that it's able to carry out. And NVIDIA has a commitment to bring a new generation of product to market annually. And actually, what's interesting for NVIDIA is it's very hard for the street to understand how companies can onboard that generation annually. So there's a whole huge body of data center infrastructure that's built on the H100. H200 is ramped and is going out, and Blackwell will start ramping in the fiscal fourth quarter. Is it possible to have all of those things at the same time? You know, it takes weeks to build data center capacity or swap in new technology. But the short or complicated answer from Jensen was yes, you can have it all at the same time. All right. Well, of course, Wall Street waiting with bated breath to see those deliveries really ramp up here. Bloomberg's Technologies' Ed Ludlow. Much more coming up from Ed at the 11 o'clock hour. But stay with us now, because joining us is Mizuho Senior Analyst Vijay Rakesh, who has an outperform rating on NVIDIA with a price target of $140. So you think about where we're trading right now. Obviously, there's disappointment out there. NVIDIA shares down about 3% pre-market. But then you consider the fact that we're up, what, 150% year to date? Of course, ignoring the fact that it's up a gazillion% over the past couple years. How are you thinking about today's disappointment? Is this a needed reality check of sorts?
Yeah, thanks for having me on, Katie. I think this was kind of a little bit expected that the Blackwell was having a little bit of a delay. But that said, you know, I think, as you mentioned, the stock's up very significantly. The 3% is really a drop in the bucket. And I think as you look at the AI space, it's still got a long ways to go. If you look at NVIDIA's data center revenues this year, they'll be on track to do 100 billion plus off a market that in the long term they've talked about a 500 billion opportunity. Obviously, you know, very strong, very secular, strong roadmap ahead. So I think this is more a new product ramp where they had a slight issue, a modest hiccup. But as CEO Jensen mentioned, they continue to see Blackwell supply start to improve significantly into first half 25. So.
It's interesting because, Vijay, at the end of the day, you have this stock declining pre-market by more than 3%. At the same time, you've raised your price target to a place where you expect it to be trading almost $20 more than where it is right now. Why did you raise that target?
Yeah, I think if you look at the margins and the guide, obviously they were all above our numbers and consensus. But the expectations coming in were obviously a little bit higher. People were looking for a 33, 34 billion plus guide, and they pointed to about 32.5 billion. But again, you know, a lot of it was primarily a bit of a delay on the Blackwell. That kind of starts to come back. The supply improves into first half next year. And as you look at this market, as you look at the AI market, there's really no competition for NVIDIA, right? I mean, they still dominate the market. They're still growing 100% year on year this year, maybe 30, 40% plus next year, even probably north of that as Blackwell supply improves. And there's really no other semi name that has a growth that's even close comparable to them, you know, doing 150, 170 billion a year in revenues with 75% gross margin. That's incredible. So I think there is a lot to be said about how they have grown into the AI market and really pushed the envelope on AI into CSPs and enterprise. So.
Well, I'm glad you brought up the competitive landscape here because obviously part of the reason NVIDIA is so far out ahead when it comes to stock market performance is the fact that they have this very meaningful lead, this incumbency advantage. But as we wait for Blackwell production to really ramp up, I mean, do you think it gives a window of opportunity to competitors such as AMD to maybe narrow that lead? It sounds like no, but certainly some of the bears out there will posit that.
No, I think that's definitely something to ponder. But what we have seen is the lead is so strong, the performance is so good that NVIDIA has been able to, flip a lot of orders from Blackwell into the Hopper 200, the H200 that's ramping, that's seeing very strong growth here in the back half. AMD, in comparison, has a good hardware. Where AMD kind of still lacks is the software side because they kind of came into the ecosystem a little bit late, and they have a ROCm software that they're trying to push and improve. But by far, NVIDIA's CUDA is still the standard in the AI market. The Blackwell and the Hopper are still the gold standards in the industry. So there's still a lot to, there's pretty good headroom for them. So
Vijay, I understand what you're saying about competition, but let's look at competition a little bit differently here. Let's look at it in terms of competition for AI investments across the industry. I understand that Mizuho still holds NVIDIA as the top AI pick. Citigroup this morning had chosen actually Apple now to supersede NVIDIA here as its top pick in artificial intelligence. Had you become close at any point to making that kind of trade-off?
Yeah, so I don't cover Apple, and I don't think Mizuho as a firm covers Apple. But when you look at NVIDIA, they are really the brains behind the AI market, right? And they are really the enablers of this whole revolution. So I think end of the day, for somebody to execute on the AI side, you still need the brains, and you still come back to NVIDIA. But I think the NVIDIA guide, the roadmap on AI definitely posits good positive trends for names like Broadcom, Credo that report next week as well. So, but in general, we would say we are very positive on the AI roadmap. Yes.
Vijay, we thank you so much for your time this morning. Of course, NVIDIA is really the top story of the day after last night's results. We're also going to get a look at some stocks now moving ahead of the opening bell because there have been a lot more results this week as we near the end of earnings season. Birkenstock, taking a look at that here because it's disappointed investors with an unchanged outlook. You have Birkenstock down about 6% pre-market. Affirm, though, just soaring. You have the expectation here of Affirm to become profitable on a GAAP basis in the fourth quarter of this year. CrowdStrike only down now about 1.2%. It's been fluctuating pre-market here and into early trading. Of course, CrowdStrike, people were watching very closely because of that IT outage a little earlier this summer. Stronger than expected second quarter results, but investors not chomping on that outlook. Now, coming up, markets are trying to look past NVIDIA's disappointing sales forecast and turn to the focus to macro drivers. We're going to speak with Invesco's Alessio DeLongis next. This is Bloomberg.
Top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. Telegram CEO was charged in France for complicity in drug trafficking and other crimes on the messaging app. Bail is set at 5 million euros for the 39-year-old Russian entrepreneur. His lawyer says it's absurd to claim the platform or its owner is responsible for the crimes. And shares of Remy and Pernod are surging after China said it won't impose temporary tariffs on brandy from the EU for now. The move comes after Chinese authorities began an anti-dumping investigation into brandy makers for retaliation for the EU's electric vehicle import duties. And the head of HSBC's wealth unit is leaving the bank weeks after missing out on the CEO role after spending 9 years at the bank. Nuno Matos headed the wealth and personal banking divisions, accounting for 41% of the group's revenues last year, Katie.
All right, we do want to bring you some breaking news, and that is about Bill Ackman allegedly seeking to revive that IPO for that closed-end fund. This is according to reporting from the Financial Times that Ackman thinking about reviving that IPO with sweeteners for investors, apparently discussing offering extra shares for early investors. Remember, that was one of the concerns about why buy it in the IPO if it starts to trade at a discount. It seems that Ackman and team are looking at remedying that. That, again, according to reporting from the Financial Times. We are 14 minutes away from the opening bell, though, so let's get a check on these futures. The S&P 500 a little bit higher, as too is the NASDAQ 100, currently 0.4% higher. The small cap index, your Russell 2000, up about 0.7%. Really interesting when you consider the fact that NVIDIA is still lower by about 3% pre-market after that rocky reception yesterday. Let's put it all together with Alessio De Longis. He is head of investments at Invesco Solutions, joining us on set. Great to see you again.
Thank you for having me.
So you think about NVIDIA and the earnings report that we got yesterday being talked about with the same sort of importance as a Fed meeting, as one of these big high-profile monetary policy decisions. And here we are, and things are a little bit higher than we would have expected on the S&P 500, given that tough welcome yesterday. How are you thinking about the interplay between the macro and the micro right now?
Well, you're highlighting really what has been the most important development in markets in the last 18 months. For the last 18 months, ever since that May 2023 NVIDIA earnings call, markets have been focused uniquely on the structural repricing due to the AI theme. And NVIDIA became the micro and the macro topic of the world for the last 18 months. But also why? Because the cycle was stable, the unemployment rate was stable, the Fed was going nowhere. There was not a cyclical and volatile cyclical backdrop to have markets focus on otherwise. But everything is changing in the last couple of months, ever since the last payroll report, and most importantly, Powell's message. I think we're going back to now focusing on the cyclical drivers, the macro drivers, because the Fed is telling us that the easing cycle is beginning, and we are a big concern about further weakening in the labor market. So I think today's price action, as you're highlighting, is suggesting that top-level indices are able to depart now from just following the idiosyncratic story of NVIDIA.
And with that in mind, I mean, it seems like the AI story still intact here, a little bit of disappointment around NVIDIA. And to your point, of course, you take a look at the Fed, they're not on hold anymore. We know that rate cuts are coming. We know that more likely than not, they're coming next month. Are those just ingredients for a risk rally here? I mean, how do you view the rest of the year?
It's a bit more tricky than we would have assumed maybe a few months ago. A few months ago, you saw every time there was a pricing of more easing, contrary to historical patterns, you saw small cap rallies, mid cap rallies, and outperforming large cap, while typically lower yields and Fed cuts that are driven by growth fears lead to outperformance of quality, lead to outperformance of larger caps. I think we're now at that inflection point, frankly, where given how we have priced already 100 basis points in cuts, any further pricing of rate cuts is actually signaling growth concerns by the market. And I think they're going to be correlated with small and mid underperformance relative to large and bond markets outperformance.
That's a very interesting view. I think another interesting view that you've taken here based on quantitative assessment here is the factors that are now going to maybe start performing better given where we are with the macro outlook. What are those factors that have a chance now in this market that maybe had not before because of certain correlations breaking down?
You're highlighting that very important point. Correlations have, over the last 18 months, especially between equity styles or factors relative to interest rates, have completely broken out ever since the inflation shock of 2022. We believe that they're starting to normalize. What does that mean? That if we do get into a more aggressive easing cycle, let's say more than 100 basis points that is already priced in, or the 200 basis points that are priced in by the end of 2025, in that environment, we expect large caps, quality to outperform, which has not been the case in the last 18 months. So the primary driver of markets in our mind is going to be a return to the macro and the cycle dominating over the structural thematic AI technology theme. Those correlation shifts can play very, very large dislocations in portfolios.
You know, you made this point about growth. It's interesting to talk about growth today when GDP surprised on the upside, partially due to the resilience of the U.S. consumer. There's still so many fears about the U.S. consumer under the surface. Time and time again, they have by and large showed up. Not everywhere, but they've showed up. At what point does that stop?
The answer is really lying now in the labor market. Consumers have shown up. We've seen it time and time again. We had the most unprecedented fiscal and monetary stimulus that is really taking years to dissipate. But for the first time, we're beginning to see, and I quote Chair Powell, the unmistakable weakening in the labor market. We're not talking about layoffs, but we're looking at a labor market that is not able to absorb the new labor participation rate, that is not able to absorb the new incoming workforce. So I think, as you're correctly suggesting, looking at retail sales on a go-forward basis, we've seen, for the last 6 months, we've seen a lot of volatility and larger revisions, which means that the data is starting to get a little bit less clear. I think consumer weakening, to some extent, is in the cards, and we're seeing also likely earnings revisions are beginning to cool off.
And I mean, if you think ahead, we get, of course, the payrolls data next week. There was so much focus paid to the revisions last week as well, a little bit delayed, but we eventually got them. I mean, do you think that the risks are now slated towards actually the Fed has to do much more than maybe they're outlining right now, that maybe the market is pricing in, if they truly are behind the curve here?
I would not say that they're behind the curve as of today. But I would agree that the risks are more skewed to the downside than to the upside, meaning up until 2 months ago, we could say if the Fed makes a mistake, it's because there are upside risks to inflation. Today, that is no longer the case. If we make a mistake, it's because there are downside risks to growth. It's another way of saying they could be behind the curve, but it's not compelling as of today that they are.
Alessio, we thank you so very much for your time. That is Alessio DeLongis of Invesco Solutions. Now coming up, Victoria's Secret revealing all in its latest earnings report. Today we're going to have details on what we mean by that in Social Climbers next. This is Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
All right, it's time now for Social Climbers. The company is making waves this morning. And first up, Dollar General is cutting its full-year sales forecast as budget-conscious shoppers pulled back on spending. You also have increased competition from retailers such as Walmart and Aldi, also hurting Dollar General's bottom line. Next up, Best Buy is raising its earnings guidance for the year. It's a sign that the retailer's turnaround efforts starting to bear fruit. Best Buy execs say that slower innovation hampered shopper appetite, but new products such as AI computers and Apple's new iPads are expected to boost spending. You can see shares currently up about 15%. And finally, Victoria's Secret is posting a profit and raising its 2024 sales outlook. The intimate apparel company said that it's seeing positive signs despite consumer pressures. Wall Street is bullish on the retailer's new CEO. Hillary Super is joining from Rihanna's lingerie brand, and Super takes the reins on September 9th. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Shonali.
And taking a quick check on futures here, very interesting. You're seeing futures higher even after that disappointing NVIDIA print. You have the S&P 500 really up now about 0.3%, and same too for the NASDAQ 100. Again, despite that disappointment in NVIDIA, but still some strength in AI there. Russell 2000 futures, this is my favorite story of the week because boy have they been fluctuating. But today it's at a greater margin upward than downward, and more so than the S&P 500 than the NASDAQ. Now coming up, under 4 minutes until the opening bell. We're going to speak with Threadneedle's Ann Berry. Of course, she has some specific stocks she's taken a look at, and of course, a view of these NVIDIA results. Is she buying the dip? We'll find out. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood ahead is just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
All right, we are moments away from the start of trading, 21 seconds to go. This is Bloomberg Open Interest. I'm Katie Greifeld. Of course, we're keeping an eye on markets on this Thursday. We have a little bit of a rally pre-market, of course, even though we got NVIDIA earnings yesterday and the outlook failed to inspire, even though we're talking about enormous numbers overall. But turns out things are all okay if you have the economy growing at a 3% annualized clip, and that's what we learned this morning. Meanwhile, you take a look at the bells right now, ringing at both the NASDAQ and the NYSE. You can see the clapping cogent on the NASDAQ there, of course, as trading officially opens in the U.S. trading day. Let's take a look at what the major averages are doing just seconds into the trade. And like I said, a rally on our hands. For now, you take a look at the S&P 500 up about 0.3%, a little bit more so if you take a look at big tech, up 0.4%, and that is very impressive, of course, with NVIDIA lower, and small caps in charge for the moment. The Russell 2000 up 0.8%. But let's get to it. NVIDIA, it's making a move lower now, down 4%. That is despite meeting and beating analyst expectations on nearly every measure. Shareholders, though, of course, are on edge as its new Blackwell processor lineup has proved more challenging to manufacture than anticipated, potentially hurting its dominance in the chip market. Again, Chanel, you take a look at shares down by more than 4%.
And Katie, I'm looking at a stock just soaring this morning, a firm higher by 23% at the open after reporting what CEO Max Levchin called a killer quarter. I quote, Levchin and analysts are now saying that the buy now, pay later company could turn a profit by 2025 as the consumer stays healthy. And speaking of the consumer, Gap reported results on their website this morning. We were expecting earnings after the bell. Comparable sales beat analyst estimates, and the company boosted its outlook for the year. You now have Gap up about 7% on the morning. Let's now take a closer look at the chip sector today, the most important sector to watch after NVIDIA, with Bloomberg's Abigail Doolittle.
Yeah, of course, Chanel. NVIDIA down here, down 3.5%. Off the lows, though, flirting right around its 50-day moving average, so some of that near-term support trying to hang in. You can see after that quarter where they did beat, although the beat much smaller than it typically is. There was a 4% top line beat. There was a 5.5% bottom line beat, much smaller than the typical blowouts that they do. You can see the space overall, not so shabby at all. Lots of green on this screen. Now, what really had the stock down yesterday was the guide. If we take a look at where the guide is at the lows yesterday in the aftermarket's down as much as 9%. So for the third quarter, this current quarter, they have guided to $32.5 billion in sales. The average analyst estimate below that. However, the highest analyst estimate well above, and we've been used to these blowout guides. I can still remember the one from May of last year when sales 50% better than what had been projected. I don't remember another company having such a blowout. This was not that, so a little bit of disappointment, some high expectations. Speaking of the stock and high expectations and the chips, we were taking a look at this yesterday. NVIDIA on the year still up 147%, an incredible, maybe ridiculous amount, and then the stocks up 22%. So really a lot of outperformance there. They're going to need to keep putting up big results, Katie, maybe better than they did last night.
Yeah, and that's a tall order, of course. NVIDIA shares down right now, even though those supply chain concerns for NVIDIA's next generation chips are going to be handled by the end of the year. That is according to CEO Jensen Huang. So let's take a listen now.
We're going to have lots and lots of supply, and we will be able to ramp starting in Q4. We have billions of dollars of revenues, and we'll ramp from there into Q1, into Q2, and through next year. We're going to have a great next year as well.
We're joined now by Threadneedle Ventures founder Ann Berry. You take a look at Jensen Huang projecting confidence there. You see the market not buying it to the extent that he would like particularly, but are you buying this dip?
I'm not actually, Shonali, and the thought I've had through my mind all throughout this is no good beat goes unpunished, right? That's been my theme for the last 24 hours. I'm not buying this dip because I think that NVIDIA has been fully and fairly priced for quite a while now, and I think that's part of the market reaction we're seeing.
So where else do you look at this juncture? There's been a conversation about broadening out that AI story. You're mentioning valuation being kind of the issue here at this juncture. Is there anything that's been left out of this kind of almost AI bubble that we've seen forming in the last couple months that's worth buying now?
I think tech's been really hard to find any value in, Shonali, and I know that we've had lots of conversation around the thematic I've been focused on, which is platformization. Which are these software companies in particular that are becoming these one-stop shops for multiple product lines, particularly for small and medium-sized businesses? And so one that I've been looking at and going into actually is Workday, which has been proving out platformization, proving out margin expansion. Again, it's not cheap, but as I look at a market that I feel is a little bit frothy, I think it's fairly valued as opposed to being overly and too richly valued.
That's interesting, the valuation question, because of course it feels like almost everything is expensive if you take a look at a stock compared to its relative history in this run-up. But at this point, how are you judging valuation? Are you comparing a stock to its own history or to relative the rest of the market?
Always. I mean, that's such a fundamental question. Always, for me, it's about relative to its own history, relative to its own cash flow profile, relative to its own revenue and earnings outlooks. I think the issue with all this relative benchmarking compared to the peer groups, I mean, that is definitionally how bubbles get created. And I think particularly in this moment when the promise of rate cuts has been on the horizon and now we know it's coming, I think it's even more important that people stop looking at the macro and start saying, okay, let's look at the fundamental profiles of these businesses.
So stop looking at the macro. That's something that's definitely hard to do. But I want to take that valuation analysis to NVIDIA because especially the bulls like to say that it's not expensive if you take a look to its historical levels, but it feels like a hard pill to swallow when you think about just this magnificent run-up that we've seen. How do you apply that analysis to a company such as NVIDIA at this point?
Yeah, I think the danger of looking at NVIDIA's valuation relative to its history is we need to look at the context of that history. NVIDIA's recent historical context has been the massive head start it's had in the chip development relative to some of the hyperscaler customers who are now developing their own. And over time, I think, Katie, that gap closes at the head start that NVIDIA has today, and I think still has in the immediate term. As that begins to go away, NVIDIA's history becomes less relevant, and it's about what's its current and future landscape, and I think it is going to get choppier, and as a result, NVIDIA is going to start looking more expensive again.
You've been asking this question, Katie, about AI hardware versus software. I just have a broader software question here because Salesforce has been on the rise this morning after the profit outlook really beat because of the cost curbs here. You mentioned Workday. You like Workday. Do you like Salesforce as well? And what else in the software sector?
Yeah, I've really liked Salesforce as well, and I've liked things, you and I talked about Palo Alto Networks in the past. The reason I've liked those has been less about the AI story. It's been less about the promise of generative AI. It's been somewhat skewed towards productivity enhancements. That's partly been AI-driven, but not as the hype would suggest. For me, the fundamental story there, again, is this one-stop solution. It's going to businesses that don't want multiple vendors. That being said, I did spot a story yesterday about Klarna severing its Salesforce and Workday ties potentially and going and doing more in-house, which I thought was a really interesting data point floating out there and frankly a little bit worrying.
Yeah, I mean, when it comes to that workday call that you have, those, I mean, how in the weeds are you following the day-to-day news flow? Because I'm sure many people who are in the stock missed that Klarna story.
Yeah, you have to be in the weeds, I think. Otherwise, you're just sort of looking at the same old stuff that everyone else is. You know, Workday and Salesforce are fascinating to me because when you look at small and medium-sized businesses in particular, and I work with a number of them, and you look at the installed base of software they're using, it's pretty prehistoric. And that's where I see the opportunity for the likes of Salesforces and the Workdays. When you get to these supersized enterprises, on the other hand, like the Klarnas of the world, I do take a little pause and say, well, how much can internal software development, how much can internal use of data actually start displacing some of these service providers? And I think the jury's out there yet. It was an interesting nugget. It made me pause.
Well, what do you think is causing it? Klarna being one company, but how many companies do you think might go the same direction? You have this strict focus on cost in this environment. Is it cheaper to do things at home or to go to somebody else to do it?
I think Klarna's an exception. I think that's a very finite and relatively small set, which are these supersized either fintech or pure play technology companies. Sonali, I think if you look at the dispersion of the size of businesses outside of that sort of mega enterprise, there's plenty of white space for the likes of the Salesforces and the Workdays. But it was an interesting data point for me. To me, it was more Klarna, which is rumored to be gearing up to go public, is under enormous pressure to show how the promise of AI is going to translate into real numbers. And I think that's where they're trying to scramble to find examples.
Would you buy into a Klarna IPO?
I would not right now.
Fascinating.
And Barry, you're sticking with us. Don't go anywhere. Coming up, Kohl's getting a sell rating from JP Morgan on concerns that the retailer's core business is eroding. Details next in our top calls. This is Bloomberg.
Howie Mandel, the newest ambassador of Skechers. Funny story.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space. Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
This is Bloomberg Open Interest. A quick check on stocks because you have the market now just shaking off any downturn in NVIDIA shares. S&P 500 up about 0.3%, holding on to those gains. And the NASDAQ 100 flying higher, 0.7%. Again, impressive despite the drop in NVIDIA. Russell 2000 now up only 0.5%. The race is on, Katie. Let's keep an eye on those small caps this week.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, Barclays says that it's time to buy Foot Locker. The firm raising its recommendation to overweight, increasing its price target as well. And remember that Foot Locker reported earnings and sales that topped estimates yesterday. The company also announcing it will relocate its headquarters from New York City to Florida to save on costs. Next up, Jeffrey says that Topgolf is no longer a buy, downgrading the stock to a hold and shaving its price target by $28. The analysts say that they are becoming more unsure about the company's prospects, especially when it comes to its debt levels. And finally, JP Morgan is cutting its recommendation on Kohl's to a sell, also cutting its price target as well. The firm says that the retailer's core apparel and footwear business is eroding, Shanali.
And we're back now with Threadneedle Ventures founder Ann Berry. Now picking up here on the consumer sector because you see so much divergence and you have to love it because divergence makes a market, doesn't it? It's finally a stock picker's market. This morning, Gap reported you had shares riding higher even though the report came out a little early, surprised investors. You have Best Buy even going higher as well. But those weaker stores are really tilted towards the lower end consumer. That narrative has been playing out. What are you buying in consumer in this market?
Well, I do think that the specialty play that we've seen recently is a really interesting place to go hunting. And I love Shanali even just now, like Kohl's being cut because core footwear's hurting. Foot Locker now getting a buy rating, right? So you've got that sort of generic, sort of general merchandiser, which is the cause really suffering. You've got the specialists like a Foot Locker doing really well. I think some of the retailers, two kinds of retailers have been doing particularly well. One is this kind of play on nostalgia, and we've seen that with Abercrombie & Fitch, which kind of blew my mind, this sort of turnaround. I remember that when that brand was like persona non grata.
I wore it this morning, I'll be honest.
And they've done a great job of refreshing their merchandising, and they've done a great job of reinvigorating their story, which at one point was really toxic. But there's sort of nostalgia for brands like that. That's a play to me into doubling down on experiential. And you and I, Katie, talked about Ulta before. Is it that beauty is a great category? It's pretty resilient. It's struggled a little bit over the last year, but as a category, it's done pretty well. But I think the reason Ulta stands to win and why Warren Buffett thinks that Ulta stands to win is it is the definition of the experiential retailer. You go in to test, you go in to try, you go in to experiment, you go in with a community of friends. Those kinds of retailers would be on my buy list, Shanali.
And it's funny, of course, Alex Steele has a phrase, invest in your face, and I think about it every time.
She spends like an hour on face care every day.
It's important. She looks great. And
she looks great.
Ulta reports after the bell today, so that'll be fun to watch. But I'm glad that you highlighted Abercrombie & Fitch. Of course, we spoke to CEO Fran Horowitz yesterday, and there's so many apparel companies, it feels like, that are trying to execute their own turnaround. How do they make their companies cool again? And to that point, I'm curious about how much attention you're paying to the C-suite right now. It feels like we've seen a lot of executive turnover this year. Victoria's Secret, of course, has a new CEO coming in. I mean, how much does management matter specifically in this environment?
It matters numbers 1, 2, and 3. I think it's, when you think about what you can control and what you can't control. You can't control the macro. You can't really control what the consumer's going to do in retail. You can control your own bench. And I think to your point, when the CFO of Apple departs, right, that's real news. There are certain companies, Katie, where I thought had huge potential, but I thought just the management team couldn't cut it. PayPal is one I've talked about on this show, where I thought that is a company that has such great potential, but just could never get the C-suite together that was able to go execute. So I think given execution's everything, who's sitting in the C-suite is everything too.
You know, the other thing you said right before we went to break is that if Klarna went public, you wouldn't buy into the IPO. Today, we also had a firm reporting. This is another derivative of the consumer play. This is about the retailer as well. Why not Klarna? Would you buy a firm instead?
No, I haven't actually gone into a firm either. So here's my position on buy now, pay later. A really clever product, right? A clever product in the way that I think Zoom was a clever product that ultimately belonged with a Microsoft, or that Microsoft should have its own version. Whether it's a firm or Klarna with buy now, pay later, great products that I think belong to as part of the suite of bigger financials like Visas and MasterCards. So my concern, Shanali, is twofold. It's concentration of the kind of product it is. I do think regulation hasn't yet reared its head in the way that it could. I think this is unregulated consumer credit that may get more attention, frankly, under the next administration, number two. And number three, the competition is getting a lot bigger because the incumbents are trying to push back on the share of wallet that these kinds of businesses are taking.
And just before we let you go, I'm curious to hear your thoughts on the IPO landscape. Of course, you do so much detailed single stock work. Does the fact that we aren't really seeing a lot of these valuable companies, OpenAI, for example, $100 billion not coming into the public markets, how do you think about that as an investor?
Well, let's take OpenAI as a really specific example. I think OpenAI, given what it's doing at the cutting edge of artificial intelligence, probably doesn't want to be doing its innovation under the public lens in terms of the scrutiny, the disclosure that's required, the pressure to hit quarterly numbers. So I put that in its own special bucket. Cutting edge companies, you know, there are puts and takes on whether you want to be in the glare of the public eye. There are other businesses, the IPO pipeline, everyone thought it was going to be a lot more robust by now, the end of the year.
And I have to get your take on this. The FT reporting now that Bill Ackman is considering bringing an IPO back for his closed-end fund in the United States. Would you be a buyer?
I would not. I wouldn't have been a buyer when it got shut down a month ago. I'm not a buyer now with all the kickers that are being suggested are going to be thrown in there, like access to future issuances and warrants. I think there needs to be a real differentiator. I have great respect for Bill Ackman as an investor. The edge hasn't been clearly articulated.
Threadneedle Founders, Ventures founder Ann Berry, we thank you so very much for all the things that are coming up in the equity pipeline, as well as all of those big earnings today. We're going to talk more about that Ackman IPO and OpenAI, about talks of a fresh round of funding for OpenAI and a brand new valuation, and it's a large one. We're going to talk about that and more in our Wall Street Beat next. This is Bloomberg.
The Principal Room, brought to you by...
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market. Of course, about 21 minutes into the trade, you can see we have green on the screen. The S&P 500 up 0.3%. The NASDAQ 100 out of nowhere is your leader. Those big tech stocks, even though we had that NVIDIA disappointment. NVIDIA shares recouping some of their losses, now down about 1.8%. That had been 4% earlier in the session, so you can see that reflected in the index overall. And the small caps, they were the leader, but now they're not. The Russell 2000 currently up about 0.2%, Shanali.
And it's time now for the Wall Street Beat. Bill Ackman considering gifting early investors in Pershing Square USA the right to buy extra shares in the future at a fixed price through warrants. That's according to a report this morning by the Financial Times. Here with more is Bloomberg's Bailey Lipschultz, who's been covering all the twists and turns of this story. What would be different, frankly, Bailey, about this offering?
This, Shonali, would be a way to entice investors to buy into a closed-end fund. Traditionally, at least in the last few years, they trade well below the IPO price. They traded at a discount. So that means that if you're buying at that $20 price that he was pushing, then you're expecting when it opens it to trade down to $18, $17, so you would be sitting on an automatic loss. The goal with this, according to the FT report, would be to incentivize investors to buy because therefore, if the stock goes higher, you can buy back at that IPO price, so you're getting a discount in the long run.
Why is he so married, Katie, to this closed-end fund structure? We've talked about this. You're like ETF queen. You've seen other hedge fund managers really turn to the ETF structure. Why doesn't he just do that?
Yeah, Scott Besson, actually, among the group of portfolio managers filing for an ETF just a couple weeks ago. And this is a debate that I've had with Eric Balchunas over in Bloomberg Intelligence, ETFs versus closed-end funds. It feels like issuers love closed-end funds, but investors prefer ETFs. But if you're someone like Bill Ackman, you want that permanent capital. A closed-end fund structure provides you that because you can't necessarily redeem the shares.
It's the guaranteed fees.
Exactly.
And that helps for Ackman pushing actual Pershing Square proper public because you have that fee.
But even with these sweeteners, I mean, an ETF would go towards solving the problem of why wouldn't I just wait for this to trade at a discount? Are these sweeteners enough to entice them even with that risk of this trading at a discount?
Well, that'll be interesting to see. And again, this is all reporting, so we don't know what Ackman is going to do. But is it enough to bring what seemingly was less than $2 billion to $25 billion? I don't know. And that's really been kind of the calling card was Ackman has this following of people on X who would be willing to buy into the IPO. But when you saw it go from 25 to 12 to 4 to 2 to pulled, that's not showing up.
Those are hard to convert into investors. To convert followers into investors, Shonali, it's a tall order. It's not guaranteed.
Another tall order out there that I want to get your opinion on here, Bailey, is this OpenAI potential funding round. Thrive Capital reported to have been putting in here $1 billion into this funding round, a lot of money. It's supposed to be valued at about $100 billion. However, they've been in talks for this for a while. What do you make of it?
Going back to the end of last year, and really the big thing has been the scarcity value of AI names and the scarcity value of an OpenAI in the private markets. We're seeing investors kind of jumping over one another to get a piece of some of these names, OpenAI, Anthropic, you name it. The fact that this is kind of dragged on longer is more interesting because it's a question of who do you want on your cap table, and also what does this mean for a potential exit down the road? Is that a 25 event? Is that something we see in 27? Or is it similar to SpaceX where private for kind of as long as you want?
Maybe better stay private. Who knows?
Maybe. I mean, obviously Elon Musk agrees when it comes to SpaceX. 10 seconds. Is OpenAI a startup?
By definition, maybe, I guess, but $100 billion and kind of being a household name that everyone knows, it's kind of hard to sell. At least to me. I don't know.
All right, Bloomberg's Bailey Lipschultz, always appreciate your reporting. Let's get to the trading diary now. What you need to be watching this week. Today, the party continues. We get earnings from Dell, Lululemon, and Ulta Beauty after the bell. We also hear from Atlanta Fed President Raphael Bostic this afternoon. Tonight, it's that much-anticipated interview, that joint interview with Kamala Harris and Tim Walz that airs on CNN. And tomorrow, we round out the week with July's PCE inflation data. Now, coming up in the next hour, we'll speak to John Stoltzfus from Oppenheimer. He joins to talk about his bullish tech outlook and talk inflation. We're going to do that with the CEO of Dickey's Barbecue Restaurants. All that ahead. This is Bloomberg.
the financial...
Saturday mornings, I understand you have off.
Yeah, Saturday is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so check us out there on Bloomberg Podcast. Alex Steele, she's off today, but Emily Garfeo, how about that, sitting in for Alex Steele for the next 2 hours? Thank you, Emily, for joining us here for the next couple hours. We're going to break down a lot of earnings out there. We got the NVIDIA. We'll certainly get to that, of course. Stocks only off about a couple of percent. We had Dan Ives come on earlier this day, and he said he didn't think he wouldn't be surprised if this stock ended up in the green today. We're going to talk some retail earnings as well. We've got Dollar General down 28%. We'll talk to Jen Bartashis, Bloomberg Intelligence, on that. We got some other retailers. We're going to break down a lot of earnings here today and talk about these markets as well. But right now, let's kick it all off with the John Tucker.
All right, thanks, Paul and Emily. As we look at the major averages right now, they are all higher. And, of course, most active in the early going shares of NVIDIA. Those shares right now down 2%. Investors wanted more from the earnings report, but most notably, it's not dragging down everything else. 4 of the 11 major index groups in the S&P 500 higher. That's being led by information technology. That's home to Tesla. Tesla shares, they are rising right now. They are up about 3.4%. This comes after William Blair initiated coverage on the automaker. They have outperformed. They also say the company's energy storage business is, in their words, underappreciated. Gap, they had earnings this morning beating sales expectations for the second quarter. They've had an overhaul with the new CEO, Richard Dixon, that appears at least to be working for now. And Dollar General, worst performing stock of the S&P 500, shares sliding. The discount retailer cutting its full year sales forecast. Shares of Dollar General down a whopping 25%. Again, the S&P 500, 31 points higher. That's up about 0.6%. We're about a little under 1% away from the record close for the S&P 500. The Dow, 144 points higher, 41,236, 239 on the index. The right now, the NASDAQ 100 up 212 points. That is a full 1% pop. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Hello, Emily. Emily and Paul.
How about that, John Tucker? We got Emily Garfeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Check that out. Emily, thanks so much for joining us today. What are you looking at today this morning?
Well, there's one stock. And
right.
I know that you've been anchoring radio for the last few hours, Paul, so maybe you're sick of talking about NVIDIA, but I'm not. I am ready to talk. And it's interesting because the NASDAQ 100, like John Tucker said, up 1%, over 1%, but NVIDIA is in the red. So market doesn't even need that stock.
No, and that's really surprising to me because I would have thought, as NVIDIA goes today, maybe as goes the market, but not so much. We had some really smart people on here. Dan Ives from Wedbush Security was in studio. Gene Munster from Deepwater Asset Management was on. And Gene Munster, I think, summed up NVIDIA, which is basically, if you believe in AI, you own NVIDIA. Simple as that. And, and he's got so much perspective and so much history with all things technology that kind of boiled it down for me. But there's a lot of other stuff going on out there in the markets today. We had some retailers reporting numbers. We had some eco data, jobless claims kind of came in line with expectations. GDP data, pretty darn solid there as well. Stocks moving here. Let's talk to Nora Melinda. She covers all the stock market for Bloomberg News. She joins us here in our studio. Nora, what are you looking at?
Well, I feel like you just about summed it up with NVIDIA. I mean, the stock has really been in focus. I mean, everyone was sitting at their desk yesterday waiting for those results to come out. And as we are seeing NVIDIA shares lower, this is coming off of the fact that there weren't as many fireworks as people expected. As we know, investors have a really high bar for this company. And I was listening to Dan Ives earlier saying that he could see that the stock moving into the green, but they weren't as good. Those results were not as good as the most optimistic of expectations. So that does not mean that NVIDIA didn't beat expectations, but that Wall Street was looking for even more. And that is coming off of its forecast as it's looking forward, that underwhelmed investors. And then everyone's really been looking for that next generation Blackwell chips. And it seems to be there's some production snags and delays coming out of that production there. So that's what everyone's kind of been looking at. But I mean, the stock is still up nearly 150% year to date. So it's hilarious that we're even sitting here talking about these marginal numbers and whatnot. But I mean, the stock is still on a tear. And as you mentioned, so many people think this is where you need to be if you're interested in investing in AI. I mean, they're a behemoth at this point. But I'm also watching Bill Ackman. I mean, there was that news that came out that he's seeking to revive an IPO for Pershing. He's hoping to offering sweeteners to early investors, essentially hoping that this will address one of the stumbling blocks that has really been struggling to make this IPO float. He says that he'll be gifting early investors the right to buy shares in the future at a fixed price. And he originally had set the target for $25 billion for the New York Stock Exchange listing for the close-end fund, which would have made it one of the biggest IPOs ever.
He just isn't going to let this go.
He's not.
But I appreciate the, tenacity that he has in this endeavor to keep this going. So I guess we'll have to watch if the investors actually take those sweeteners.
If they take the bite.
How about Salesforce? What's happening there?
I mean, I'm watching Salesforce. That is on the upward swing. So it's in the green, but the stock is pairing pretty sharply. Earlier it was up as much as 5%. And this is after its profit outlook, which was really driven by some curbs to costs. And so it did top analyst expectations, those earnings. And so a lot of investors did have concerns over slowing sales growth at the giant, the software giant. But it seems as though it did top what analysts were really looking for here. So great news out of Salesforce.
I called out Dollar General earlier and showing them in Bloomberg Intelligence with Tom Keene. Stock down big today. What's going on there?
Big time. I mean, shares are sinking badly. The stock is seeing its worst day ever. And they're plunging as much as 26%. That's the lowest level that the stock has seen in the past 6 years. And this is after its core customers are really seeing a budget crunch, which is so interesting to me. I feel like every time I'm on the show, we can never really get a clear read on the consumer. They're spending here, they're pulling back here. Never thought the Dollar General would be the place that you pull back from. But apparently, customers aren't opening their wallets to the same degree that they were before. I mean, I think about Dollar General, all the really
Maybe they
budget
just
friendly.
like clean the stores with a broom once in a while.
See, and wouldn't that be nice?
That's
not the dust bunnies in the corner.
Maybe it's like they're staying away because the stores are filthy.
They have something like
be.
20,000 locations that they have to keep track of, John.
So,
So
John,
just get a mop once in a while.
But John raises a good point. I was reading the Bloomberg News reporting, and yes, there is the macro headwinds of the lower-end consumer facing, economic challenges, certainly. But it's also the company specific, as John Tucker was pointing out. That I mean, there's a lot. They brought back their former CEO to try to turn this thing around, and I guess part of turning it around is improving the in-store experience. But obviously, looking at the numbers and looking at the guidance, that's not happening, right?
It doesn't seem to be the case at all.
All right, very good. Norma Linda, thank you so much for that. Norma Linda, she covers all the equity markets for Bloomberg News. All right, for our good friends up in New England, Bloomberg 106.1 and 1330 are moving to 92.9 FM starting September 3rd. So listen to Bloomberg Radio in and around Boston on 92.9 FM. It's your new source for business news from the financial center of New England. Bloomberg Radio moving to 92.9 FM at noon, the day after Labor Day. So how good is that? Let's check in with Dan Morgan. He's a senior portfolio manager, Synovus Trust Company, joining us on Zoom from Atlanta. Hey, Dan, what did you make of the NVIDIA earnings last night, the conference call, all of that?
Well, I have kind of a little bit more of a positive bias view towards the stock than maybe the rest of the street does. You have to bear in mind that we added NVIDIA to our buy list back in about 2018, 2019, when they were really gaining a lot of momentum in the data center space, kind of gaining market share against the likes of AMD and Intel. And up to that point, as you know, they were construed as a company that produced chips that were going into various video games that people played. And, they had a big spike in their demand during COVID, and then it kind of pulled back on that. And then obviously the whole thing flipped where their data center revenue became far greater than the gaming unit. And then the AI thing exploded about, a couple of years ago, and the rest is history. So, overall, to be honest with you, I think this is a stellar report. I think the street has just gotten to the point where they've become so spoiled with these huge colossal beats that NVIDIA's put together the last 4 or 5 quarters, that their expectations have just gone off the ray. I mean, even if you look at this number they did on the third quarter, they topped the consensus estimate. Obviously, there was whisper numbers of 33 and 34 billion, but let's face reality, it was a strong number, 32.5 billion. So I think everything is still on track with NVIDIA to ship the Blackwell chip out next year in volume, and I would expect margins to continue to rise because the average selling prices on these Blackwells are anywhere from 25, to 35,000, far greater than what they're getting on the Hopper and the H20s.
Talk a little bit about some of the production issues that NVIDIA is having with the Blackwell chips, and what did you learn from this earnings report about how quickly those can be resolved?
Well, Emily, that's been one of the big issues. Also, supply constraints as they try to build out this network of suppliers to kind of ramp up for Blackwell. I think it was kind of expected that this upcoming October quarter that there would be some shipments out, but it's not going to be in volume. They're still going to be relying on the H20 and the H200 like they did in this quarter, really to really post huge gains. I just think it's growing pains. I really am not concerned about it. I think they'll work through it. They've done a dynamite job back when we were having huge supply constraints in the overall chip sector. You all probably remember, trying to buy a new automobile and you couldn't get a chip to go in a new car. I mean, they worked through that and still did very well. So I think they'll get through this hurdle and they'll start doing volume probably, like I said, first half of 25. So again, Emily and Paul, you're asking the wrong guy, right? Because I'm an eternal NVIDIA bull. So.
Hey, Dan, far be it for me to call you an old man, but you've been covering this tech industry for a long time. Where are the competitors here? That's kind of my question. I would think with this, we'd see the AMDs of the world and some others really, Intel, even Intel maybe. Why does NVIDIA have seemingly such a stranglehold on this part of the market.
You know, it's interesting, Paul. When I started really, diving into the stock and covering it very closely, sitting in on the developer conferences and all the conference calls, they would mention AI. They talked more about Omniverse. And then, of course, the AI thing took off. And then, by the way, we're 70% of the AI market. They would mention that in their public release, and nobody would care. But you're right. Everybody else has been extremely late getting to the table. You've got AMD with their MI300 chips. You've got Intel rolling out their Gaudi 2, Gaudi 3, and their Falcon Shores next year. But again, that's in 25. Marvel has the PAM DSP chip. You probably covered on your show about Huawei coming out with their Ascend 910C chip to compete against the H20. But Paul and Emily, where the real competition may come in is from the hyperscalers, who are their top purchasers, right? About 50% of their revenues come from them with their own internal chips. We know that Meta, we know that Google has the TensorFlow chip that they developed with Broadcom. They have version 6 right now. I think there's a dual chip coming out called Athena that they're working on also. So there's a lot with AMD. There's a lot of things going on internally where these hyperscalers are trying to become less reliant on NVIDIA. But quite frankly, guys, the chips they're coming out with still aren't going to top the performance they're going to get out of Blackwell. But they could use it for lesser capability, tasks, so to speak, and try to save some money from, as I mentioned before, the average selling prices are very high on these newer chips.
So revenue doubled in the quarter, Dan, but yet the stock is down this morning. I'm just wondering, I know you said that investors might be getting a little spoiled. What do we need? Like, what does the street want to see out of NVIDIA then to move this stock up higher if revenue doubling isn't enough?
Yeah, I mean, again, Emily, it's perplexing for me. I mean, like you said, you look at the revenue year over year, it was up, a huge amount, 122%. You had the data center group, which was up 154%. I've got the data center group going over $100 billion in revenue for 25 compared to $44 billion in 24. So that's more than a double just in that unit. So again, this has become such a momentum stock, right? I mean, it trades at 60 times price to book. The Philadelphia Stock Exchange Index trades at 6 times book. It's a trailing 75 times earnings. So you have this massive multiple, this huge momentum. You have this situation where you can't make any errors at anything that you're reporting. Otherwise, you're bringing the stock down. So again, I just think, quite frankly, NVIDIA has kind of spoiled investors, since that dynamite quarter about 2.5 years ago. And people just keep raising the bar, and they're never satisfied. But they're still doing really well.
Hey, Dan, you raised for me what I think would be the biggest risk, which is my customers are going to develop their own chips. Frame that risk out for me, and how do you think about that?
Yeah, I mean, that is a risk. Every single hyperscaler, as I mentioned, has their own chips. Probably the best chip out there is going to be coming from Alphabet and the Broadcom joint venture with their Tensor version 6, what they're bringing out. So, that's the worry. Even Apple has their own chips now. So the worry is that instead of buying all their chips from NVIDIA, or 80-90% of chips from NVIDIA, maybe a little bit from AMD, let's say, or Marvel, they may start, keeping 30-40% in-house and saving money and using their own chips. So that does potentially slow demand down for NVIDIA chips in the data center space. However, if you're probably someone in charge of this for NVIDIA, you're saying, well, guess what? We're starting to get demand from other sources, right? Enterprise, we've got demand from Tesla. They talk about different governments who are now buying data center chips for their own use. So you could make a case that, yeah, maybe you're going to lose a little bit from the homegrown stuff coming from the hyperscaler, but then you're going to be able to grow it out by the fact that you're going to get greater demand from these other markets that you're not getting right now. So,
it's a pretty,
I mean, there's a lot of moving parts, but I mean, I still feel, Paul and Emily, that we're at the beginning of this ride out. And, the key to making money in technology, and Paul, you alluded to the fact that I've been in this for a long time. I've been writing research and following and buying tech stocks since 1990. The key is to ride a wave. And if you ride a wave, it always goes up and then wides out. And, you know, in the early 90s, you had the big, you know, movement toward the internet. You had everybody going to a mobile phone. If you caught one of those waves with the right stock, you did great. So
exactly.
You know, you're on an AI wave in the chip space right now with NVIDIA.
Very good. Dan Morgan, thanks so much for that. We really appreciate getting a few minutes of your time. Dan Morgan, he's the Senior Portfolio Manager, Synovus Trust Company down there in Atlanta. He was early on NVIDIA. He was right on NVIDIA, and it's been a heck of a run. The stock just this year up 142% year to date. We're going to have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Again, most active NVIDIA, and those shares right now after the earnings report, after the close of regular trading, they are falling right now 4.7%. They've actually been all over the place. S&P 500, though, 24 points higher. It is up 0.5%. The bigger story, it's not dragging down the major averages. Dow Jones Industrial Average, in fact, intraday record there for the Dow. It's up 0.6%, 248 points higher at 41,338. The tech-heavy NASDAQ 100, that's up 135 points, up 0.7%. I did get some economic news today. Revision to, well, not a revision, the second update to the gross domestic product with the second quarter rising at a 3% annualized rate. That's during the April through June period, up from the previous estimate of 2.8%, and that was all powered by personal spending. Worst performing stock in the S&P 500, Dollar General, cutting its full-year sales forecast. The turnaround efforts there may not be getting the job done. Dollar General 26% lower, and then we have shares of Best Buy, best performing stock in the S&P 500, that raised its earnings guidance for the year. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Emily and Paul.
All right, John Tucker, thank you so much. We appreciate that. Emily Garfeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Aside from NVIDIA, Emily, another big tech story out there is ASML. The Netherlands plans to limit ASML Holdings' ability to repair and maintain its semiconductor equipment in China, a potentially painful blow to Beijing's efforts to develop a world-class chip industry. So that tech Cold War seems to be pretty hot out there these days. Let's get some latest on that. We'll do that with Sarah Jacob. She's an Amsterdam bureau reporter for Bloomberg News, joining us from Amsterdam via Zoom. Sarah, this seems like a pretty big step by the Netherlands government to limit ASML's business with China. Give us the background.
Well, essentially, the Dutch government will likely not renew certain ASML licenses to service and provide spare parts for its chip equipment when some of those licenses expire at the end of this year. The move is expected to cover ASML's top-of-the-line machines. So we're talking DUV machines, which are deep ultra lithography machines. We know that ASML's most advanced chip-making equipment are sold with maintenance agreements. So a decision to limit ASML's ability to repair and maintain those machines could make at least some of those machines inoperable in China as soon as next year.
And what was the rationale behind this ban?
Well, the Biden administration has sought to limit China's advances in the semiconductor sector for some time now, and it has implemented sweeping export controls on China on the sale of advanced chip making equipment, over citing national security grounds. So we have also previously reported that the Biden administration has raised the possibility of imposing the FDPR, which is essentially a rule that allows American officials to control the flow of foreign products built with even the tiniest amount of, technology originating from the U.S. And in this context, the U.S. has sort of also been urging the Dutch government and many of its allies to align their China controls with the U.S. So that's sort of the backdrop for this move.
What percentage or how big is China for ASML? Because I'm looking at the stock. The stock's actually up today. I thought it would have been down maybe materially.
Well, China is, accounts for about half of ASML sales. So we do expect if this were to be announced, it would impact ASML sales. And these new curbs would put ASML under the same constraints that U.S. peers such as, Applied Materials is experiencing. But the implications of such a move also is for China, right? It's in terms of obtaining more spare parts and maintaining machines are critical to the smooth operation of a chip plant. And China relies on ASML's immersion DUV lithography systems to advance its chip-making technology. So for China, it would be a blow to in its efforts to develop its chip industry. It could make it difficult for Huawei and Semiconductor Manufacturing International Corp to make breakthroughs in their current capability.
Is this ban expected to then, if it's not going to be good for the Huawei's of the world, is it better than for U.S. chip companies? Is that the idea here?
It's essentially just part of this broad, plan by the Biden administration and its allies to sort of limit China's advances. So that's the real goal over here. And ASML being, one of the largest and makes this most advanced chip making equipment that others don't have in the world is very critical in this whole plan. across both the U.S. and the Dutch government.
To what extent, Sarah, is the feeling within the Netherlands that this is ASML just following U.S. policy versus maybe acting a little bit more independently? How willingly is ASML doing this?
Well, this is coming from the Dutch government. So the Dutch government under Prime Minister Mark Rutte, which was the previous Prime Minister, had resisted U.S. pressure to add additional restrictions on servicing, arguing that they needed more time to evaluate how the export bans had taken effect. But we say with the new administration, Dutch Prime Minister Dick Schoof earlier this month said the government has good negotiations with U.S. and Japan, and he expects they will end with good results. So we'll have to see.
Sarah Jacob, thank you so much for joining us. Really appreciate that. Sarah Jacob, she's an Amsterdam bureau reporter for Bloomberg News. How cool is it when you got news coming out of Amsterdam? We have a bureau there, and we have an expert right there that we can talk to. That is the power, folks, of Bloomberg News. Matt Winkler building that with Mike way back in the day, and we can tap into that for Bloomberg Radio. So some great stuff. Sarah Jacob, Amsterdam bureau reported there on ASML. Let's switch gears to a little retail here. Best Buy. This stock is up 17% today. They put out some numbers that really showed, I guess, some cost cutting really helping out there. Lindsay Dutch, she is our expert. Lindsay, Best Buy, I mean, I like them and everything, but up 17%?
Yes, so it is based on the sort of strong results and the raise on the earnings profit in terms of guide for the year. But I think what's really driving the optimism around the company is that after 3 years of sort of battling really difficult comps coming off of like a pandemic-driven pull forward in demand, we are now seeing light at the end of the tunnel, and Best Buy should be returning to growth mode soon.
Talk a little bit more about what consumers are buying when they go to Best Buy. I have to be honest, I haven't been in a Best Buy in a while. The last time I was there, I bought a humidifier, which
was it an AI connected humidifier?
It wasn't, and I don't think that's what the core Best Buy customer is going in and buying from the stores.
You're right, appliances are still a little bit weak. But in terms of strength, and we've seen this sort of building basically since the end of last year, is really coming on the laptops and the computers, tablet side. So it's been about 4 years since COVID, when everyone bought brand new devices, that replacement demand is really peaking at this time. And then there's an added benefit of that. We are starting to see new product in this area as well. Microsoft has rolled out some new laptops that have AI technology. We're seeing some innovation coming from Apple that we should see later this year. So it's sort of this magic combination of this replacement demand in that category and new product hitting the market at the same time. Obviously, Best Buy does benefit here a little bit from back to school. So they had a very strong July. Comp sales were about flat, and they're seeing about the same in August. And a lot of that is driven sort of this fall shopping season in those categories.
That's kind of where I want to go, Lindsay. I'd love to get a sense of kind of what you're hearing from the Best Buys of the world and the other retailers that you cover. What are they saying about the consumer these days?
Yeah, so I was thinking about that a lot with this release, and I think that the consumer over this year, has become more selective, more value focused, but they are spending, and even spending on expensive things like laptops, if they really need it or want it. And this trend of new product is really helping fuel that. So customers getting selective or value focused in certain areas, and then sort of splurging in a category where they really see something new that they really desire to have.
Lindsay, we only have about a minute left, but just walk us through what's the biggest risk for Best Buy going forward? Is it something macro related, or is there a company specific risk that you're looking out for?
Yeah, so I think for the fourth quarter, there's still a lot of uncertainty around that. What's going to happen with holiday? We saw last year that the season was very compressed in just a few selling days. This year, we have one less holiday selling week in the period. So I think we'll get more information once we see that. But I think the broader challenge for Best Buy is that the consumer electronics industry, has been faced with a lot of challenges and hasn't been growing. So while Best Buy has stood out, in terms of results this quarter, everyone is looking for a return to growth, not just for Best Buy, but for the industry. And so that, I think, is, the biggest risk going forward.
Lindsay, great stuff. As always, really appreciate getting a few minutes of your time. Lindsay Dutch, she's the Consumer Hardlines Senior Analyst. Boy, I missed that one, the promotion to senior. She's awesome. I'm glad we got her at Bloomberg Intelligence. Can't remember who hired her back in the day. But she's great, so we appreciate that, Lindsay Dutch. Coming up, Barry Ritholtz, the founder of Ritholtz Wealth Management, host of Masters in Business. We have no idea what we're going to talk to him about, but I guarantee you it'll be entertaining 7 minutes. With our news in New York, here's Michael Barr.
Thank you very much, Paul, Emily, and John. Vice President Kamala Harris and her running mate, Minnesota Governor Tim Walz, will sit down for their first major TV interview of their presidential campaign. Tonight's live interview will be on CNN. We get more from Bloomberg's Julie Fine.
It's a very high-stakes moment for her, and she's also taking some criticism because she's not doing the interview alone. She is doing it with Tim Walz. However, at the end of the day, she is going to be the one that has to answer the questions, even if he's just sitting right beside her. So it's high stakes. It's the first time it is that situation. It is a one-on-two.
Bloomberg's Julie Fine reports the Harris campaign is brushing off the criticism, saying former President Trump has also done joint interviews with his running mate, J.D. Vance. The Harris and Vance continue to travel in southeast Georgia on a bus tour. Former President Donald Trump campaign in Michigan and Wisconsin as his campaign efforts in a handful of battleground states ramp up. His visit today to Michigan will be his third in the past 7 days. Michigan and Wisconsin, along with Pennsylvania, make up a crucial set of swing states. National Security Advisor Jake Sullivan met with Chinese President Xi Jinping in Beijing after 3 days of talks to ease tensions between the U.S. and China ahead of the November election. The agenda included Taiwan, Russia, and the U.S. demanding that China help stem the flow of ingredients used to make fentanyl into the U.S.
President Biden is committed to responsibly managing this consequential relationship to ensure that competition does not veer into conflict or confrontation, and to work together where our interests align.
She told Sullivan that Beijing was committed to a stable relationship with Washington. Global news 24 hours a day and whenever you want it with the Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
webinars.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages, they were all higher. In fact, the Dow Jones Industrial Average had an intraday record. And all this comes despite the fact that NVIDIA shares are lower. NVIDIA, one of the most actively traded stocks today, down 3.3%. After the chipmaker issuing a forecast that failed to live up to pretty elevated expectations, we'll say, even as the company's results showed strong growth in the latest quarter. Right now, the Dow Jones Industrial Average up 270 points. That's a rise of 0.7%. We're at 41,361 on the index. S&P 500, 39 points higher. That's up 0.7% at 5630, still shy of the intraday of the record for the S&P 500. NASDAQ 100 right now up 215 points. That is a rise, the tech-heavy NASDAQ, of 1.1%. Worst performing stock in the S&P 500, that belongs to Dollar General. Those shares are down 27% right now. The discount retailer reporting second quarter comp sales missing expectations. They also lowered their outlook for sales and profit for the full year. And then you had results this morning from Gap beating sales expectations for the second quarter. The new CEO's overhaul appears to be working there. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Emily and Paul.
All right, John Tucker, thank you so much. We appreciate that. Emily Garfeo, Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. Emily's sitting in for Alex Steele. We're also streaming live on YouTube, so check us out on youtube.com, search Bloomberg Podcast. All right, it's Thursday. That means at this time, Emily, we talked to Barry Ritholtz, the Barry Ritholtz, host of Masters in Business on Bloomberg Radio. I think he's got a new hip or a new knee or something, John.
Hold on, let me put up the cones and the padding on the wall so
yes.
It doesn't break anything.
I know. He's a founder of Ritholtz Wealth Management. That's his day job, but he also is the host of Masters in Business on Bloomberg Radio. You can download Masters in Business podcast now at Bloomberg.com or wherever you get your podcasts and catch the show every Saturday at 10 a.m. Wall Street time on Bloomberg Radio. Hey, Barry, I'm looking at a day here when NVIDIA, seemingly the driver of the U.S. stock market, is down 3.5% on some maybe not as great as people anticipated guidance, yet the markets are higher. The NASDAQ's up 1%. What does that tell you?
Yeah, it's almost as if it's a market of more than a single stock. You know, I've been hearing from the perma bears and the Malthusians for the past 3 years, oh, the market is so narrow, it's just these few companies. It's not, just ignore all-time highs in the stock market, just ignore all-time highs in earnings and sort of a sweet spot between growth and inflation. Ignore all that. It's just FANG. Oh, wait, we no longer call it FANG. Now it's FANG with an M. And wait, it's now the Magnificent Seven. Oh, wait, the Magnificent Five. I don't know how else to say this, but a robust economy with relatively modest inflation and ongoing fiscal stimulus, a shortage of houses, a shortage of semiconductors, and a shortage of labor means up and to the right. I mean, this is not rocket science. This is pretty fundamental stuff. If we saw a lot of other companies like really missing and downgrading guidance, that's one thing. Dollar General, their clients are the most pressured part of the economic strata. And that should be a big wake-up call to Chairman Powell. Hey, if you're in the bottom half of earners, high credit card costs are killing you. If you're in the top half, you're paying cash for homes in the Hamptons for $5 million. You're buying condos and co-ops in Miami and New York. It's a little bit of a bifurcated economy, and I think the Fed has a little bit of work to do to extend what the robust economy further down the economic line.
So Barry, are we looking at an economy that's ready for the Fed to start a rate cutting cycle, as in not just one 25 basis point rate cut, but a cycle where they really bring us back to perhaps where we were before the hikes began?
Well, certainly not bring us back to not where we've been over the past 20 years. We're not going back to zero. I can't imagine that short of a catastrophe. However, so what have we learned over the past 20 years? We've learned that monetary stimulus works great if you got some monetary in your pocket. But fiscal stimulus seems to work its way through the whole economy. We've learned that zero creates all sorts of oddities, and we've learned that 5.5 is a little high for an economy that is so dependent on credit. And we've also learned 525 basis points in rate hikes in 18 months. Hey, the Fed's going to break stuff. You know, Silicon Valley didn't happen. Silicon Valley Bank and some of the other banks that kind of blew up. I never thought I would read a story that this well-established, well-capitalized bank is now forced to reorganize because of losses on treasuries. I mean, it just seems so counterintuitive. So there's been a ton of lessons. And I think the biggest lesson that the Fed should learn, aside from the fact that they're always behind the curve, they were 2 years late to recognize inflation. They're now, inflation peaked in June of 2022 at 9% and pretty much headed straight down. I think that, and plus we have all these mortgages locked up at, 3.75, 4.5%. That's really constraining supply. I think the Fed needs to find that Goldilocks spot where they're not, we go back to 0, 1, 2% in this fiscal era. You're going to cause some inflation. Obviously, that massive CARES Act, the first one was the biggest fiscal stimulus since World War II at 10% of GDP. But if you find that sweet spot, if the Fed could get to pick a number, 4.5, 4.25, that frees up some of those mortgages that people just can't move because, wait, you want me to give up my 4% mortgage and buy a house at 7%? It doesn't make any sense. Free up some of that supply, encourage more CapEx, encourage more manufacturing, encourage more commercial construction. I mean, all expansions, all economic expansions eventually end, but there's no reason to think that this can't continue for 2, 4, 6 years. Yeah, there's a recession out there somewhere, but right now the risks are to the downside, primarily due to tight credit.
Hey, Barry, I know you communicate regularly with your clients at Ritholtz Wealth Management. What's been the latest missive or two you've sent out recently that you want your clients to be thinking about?
So, we all have a tendency to engage in a little narrative fallacy. After we figure out what happens, after we witness what happens, we think we know exactly why, because we create just a very lovely Joseph Campbell-like story with a hero and an anti-hero, and everything is black and white and really simple. And the last missive I sent to the clients were, hey, we're at the edge of rate cuts, finally. Wall Street's been wrong about this for 3 years. They've been wrong about the impending recession for 2 years. Let's look at how we got here. And when you look at all the moving parts, we've underbuilt single-family homes for 15 years. We're probably 2, 3, 4 million homes short. Just-in-time delivery adds a few pennies per share in profit, but the trade-off is a great deal of fragility that in the event of emergency becomes a crisis. And we continue to have a labor shortage. Traces all the way back to 9/11. It's insane to say that, but really, if you recall, following the terror attacks, we changed the rules about who could stay in the country after they get their undergraduate or graduate degree. most of those people, or many of those people, end up in Silicon Valley. Half of the C-suite in technology is foreign born and educated either here or overseas. So you have all these moving parts. You have all these different things going on. And what we really need to think about is, how do we make sure that this abundance that, I don't know, the top half of the economy gets to enjoy, how can we make sure that everybody in the country can participate in it?
Exactly. All right, Barry, thank you so much. Some big things to think about there. Barry Ritholtz, host of Masters in Business on Bloomberg Radio. Fantastic podcast. Get that wherever you get your podcasts. His day job is he's the founder of Ritholtz Wealth Management, and he's a good friend of Bloomberg. He's a Bloomberg opinion columnist back in the day, so we got a lot of work coming out of Barry Ritholtz here today. S&P 500, that's up 0.7%. The NASDAQ's up 1.25%. This is Bloomberg. Good morning.
Company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. Look at some of the company stories we're following. Let's start with Allstate. They are set to increase home insurance rates for California customers by an average of just over 34%. So this marks the biggest jump in premiums for a major insurer in 3 years. The state there facing a deepening property insurance crisis. The rate hike takes effect over you. Some of those customers actually going to face premium increases of up to 650%. The increase, part of the broader upheaval in California's insurance market, with top insurers like State Farm, Farmers, and others pulling back from the state, citing the escalating costs of wildfires and regulations that have capped rate hikes for decades. Want to check into the Ritz-Carlton, New York Nomad, the first weekend in October.
Sure.
That'll be $1,300 for a standard room. Room at the Four Seasons Miami Surfside that weekend starts at $1,500. The Journal has this story that more hotels routinely charging and getting four-digit nightly rates. Inflation-scarred budget travelers may be pulling back, but the affluent ones like Paul still have lots of vacation money. Emily, I was actually saving this for Alex, but Human Mobile Devices, HMD, unveiling its Barbie flip phone, designed with lots of pink and without social media. The company partnering with Mattel to create the retro device is going to help cut down on screen time to focus on living the Barbie lifestyle.
I love that.
Yes, so there you go.
Is that for kids or for adults?
I think I'm going to get it. That would be an upgrade for me. And that's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, NVIDIA stocks down 2.5%, but not to worry. The broader markets are higher here today. S&P up 0.8%. The NASDAQ up 1.3%. Yields 10-year Treasury 3.88%. That's up about 4 basis points here. And BitDog, Tom Keynes up 2.5%. 60,800 on that cryptocurrency. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Emily, and John. Vice President Kamala Harris is getting ready for her first interview as the Democrats' presidential nominee. She will sit down tonight with CNN's Dana Bash alongside her running mate, Tim Walz. Brown University political scientist Wendy Schiller has more on the stakes tonight.
She's conducted many interviews, right? I mean, in all of her political career. So it's not the interview itself. It's the new role that she has and setting the tone for her candidacy. And I think that's what people are looking for. So, you know, when you have a captive audience like the DNC or these rallies, you can give whatever speech you want, but you're not answering somebody's question, which may or may not make you uncomfortable.
Wendy Schiller of Brown University. Donald Trump's running mate, Senator J.D. Vance, was in Wisconsin. Among the things he was asked about, former President Trump's controversial visit to Arlington National Cemetery on Monday to attend a wreath-laying ceremony. NPR reports Trump campaign officials were asked not to take photos or videos in a specific section of the cemetery, which allegedly led to a verbal and physical altercation with a cemetery employee. At last night's rally in Green Bay, Senator Vance downplayed the incident.
You guys in the media, you're acting like Donald Trump filmed a TV commercial at a gravesite. He was there providing emotional support to a lot of brave Americans who lost loved ones.
Overnight, the New York Times reported the cemetery official has opted not to file charges, reportedly fearing retribution from Trump supporters. In the West Texas desert this morning, space tourism took another 62-mile leap into space. Jeff Bezos' Blue Origin carried another 6 civilians into space for 11 minutes. The passengers aboard the reusable New Shepard included a philanthropist, a cardiologist, a university professor, and a college student. Global news 24 hours a day and whenever you want it with the Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Paul, Emily, John.
All right, Michael Barr, thank you so much. We appreciate this. I think this story is up my alley. I'm not sure. You might go a little far. Staff at billionaire Chris Ellison's mining company have already been banned from working from home. Stepping outside for a cup of coffee could well be the next endangered perk. Quote, I want them captive all day long, Ellison, chief executive officer of Mineral Resources, said on Thursday. I don't want them leaving the building, so I don't want them walking down the road for a cup of coffee. We kind of figured out a few years ago how much that costs. Ellison was championing the perks of working at the firm's 2-year-old Perth headquarters, which boasts a cafe, restaurant, gym, creche, don't know what that is, reflection room, and wellness center. The 67-year-old mining veteran said that staff loved working in the building, and its facilities kept them glued there.
Shouldn't they be in the mine?
Could be. I mean,
why do they have a building?
Imagine what the conditions are in the mine if your white-collar staff are being
allowed to
held
go
captive.
out.
I mean, it sounds a little harsh, but
in this new world, but that's
I mean,
the
if
way
you,
it was.
It does seem like there are a number of amenities here. I mean, we don't have a gym at our Bloomberg headquarters. Cafe, restaurant. I have to say, though, it is nice to sometimes clear your head with a walk outside the office, even
Sure.
if there are amenities inside the building.
Wait, are you complaining about Bloomberg?
Oh, no.
Hey, nice knowing you.
Never, of course.
Who's your host tomorrow, Paul?
Never.
Here's a quote here from Mr. Ellison. I have a no work from home policy, he said in the transcript of a call with analysts following an earnings update. I wish everyone else would get on board with that. The sooner the better. We can't have people working 3 days a week and picking up 5 days a week pay. That seems extreme because, I mean, all the data, I think, points to people, this economy's been as productive,
Yes.
if not more so, over the last 3, 4, 5 years than it was ever. So, I mean, again, that's a shock to me. I remember at the beginning of the pandemic, I said, no way can these Wall Street traders trade from home. Well, guess what? They did, and they crushed it in 2020, 2021, and 2022. So go figure. Work from home, hybrid, I don't know. I'm here every day, as is John Tucker.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to have some really smart research analysis. First with Jen Bartashes. She's a Bloomberg Intelligence analyst. She's going to give us the latest on Dollar General. The stock's down more than 25%, some weak results there. And then Gene Munster, managing partner at Deepwater Asset Management. Really one of the smarter voices out there, in my opinion, on all things global technology. He's going to give us his thoughts on NVIDIA. Scott Kelly, founder and CEO of Atos Capital Real Estate, and Abigail Doolittle, a Bloomberg News markets reporter. They're going to join us here in studio to talk about the U.S. commercial real estate business. That's a story we want to stay on top of going forward. Right now, let's kick off this hour with Mr. John Tucker in a Bloomberg Business Flash.
All right, stocks rising on Wall Street, even though AI darling NVIDIA disappointed with for investors who wanted more from their earnings report after the close yesterday. Dollar General slumping right now. That is, in fact, the worst performing stock of the S&P 500. It is down 27% after cutting its earnings forecast. Best Buy, that's jumping over 12%, the largest consumer electronics chain in the U.S., beating forecasts, even as sales slipped, and they also cut their guidance. And as we look at Best Buy, those shares, they are jumping 12.8%. The key report this week, the economic report coming tomorrow, the government releasing its July data on inflation with the Fed's preferred read on inflation. That would be the PCE. S&P 500, 41 points higher. That is up 0.7%, 56.33 on the index. The Dow Jones Industrial Average, an intraday record there, 225 points higher. That is up 0.6%, 41,316 on the index. The Nasdaq 100 right now, 238 points higher. That is up 1.2%. As far as yields, the two-year yield, 3 basis points higher. That is at 3.89 right now. And the 10-year, 4 basis points higher. That is up 3.88. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Emily.
All right, John Tucker, thank you so much. We appreciate that. Emily Grafeo sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live as well on YouTube. So go over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. And some big news for our New England listeners. Bloomberg 106.1 and 1330 are moving to 92.9 FM. Starting September 3rd, listen to Bloomberg Radio in and around Boston on 92.9 FM. It's your news source for business news from the financial center of New England. Bloomberg Radio moving to 92.9 FM at noon the day after Labor Day. And Labor Day is a big weekend up in New England because their summer's like 15 minutes long. So they go hard from July 4th to Labor Day.
They put those white jeans on.
Yep.
And then after,
no,
time for a sweater.
Exactly. The Cape, Nantucket, the Vineyard. Awesome places up there and great in the summertime. So our good news for our good friends up there in New England. Let's check out what's happening in the market. Markets are kind of moving higher here, as John Tucker is just reporting. The NASDAQ up over 1%, and that S&P up about 0.75%. Nora Melinda, Bloomberg News, she covers the equity markets for us. She joins us here in our studio. Nora, what are you looking at?
Well, I'm done talking about NVIDIA. We know the story there. High bar. Investors are very, very optimistic about the company, and it didn't hit those high expectations. But I want to take a look at Best Buy. Now I'm seeing shares of Best Buy, that's ticker BBY, jumping for the best day since 2020. And this is the highest level the shares have seen in more than 2 years. We're seeing shares rallying as much as 18% in trading today. And that is after this turnaround story that the company has really been trying to see. It seems to be bearing fruit. It says EPS should be as high as $6.35, and that's up from $6.20 that were expected previously. But retailers more broadly have really described a U.S. consumer who is prioritizing essentials, but is also increasingly buying new and trendy products at the right price, and that seems to really be benefiting Best Buy here as they're really getting a lot of tech sales.
Interesting. Good stuff there. I mean, the retail has been a mixed bag. We're going to talk to Jen Bartashis in just a moment on Dollar General, but the retail, it's hard to get a read on that consumer.
Very hard. I mean, I think about Best Buy, I immediately think back to college when it's time to get that new laptop. I used to pretend I hated to go, as my dad would just go around the store looking at all these tech products, but deep down, I was having fun inside.
Exactly.
You can always watch the TVs. I feel like as a kid, I would always like to compare which TV had the best color, which one was the most HD.
Looking at the price tags, too.
Yeah.
Exactly. What's Bill Ackman up to these days?
I mean, so obviously he's really circling back to that IPO. He's really wanting to see if he can entice more investors and really get them in on that closed-end fund that he's really been trying to push. So this seems like another effort to really see if he can push and gain some momentum behind that effort. So that's what we were seeing from headlines earlier this morning. And of course, our team is keeping an eye all over it.
What about CrowdStrike?
Yes.
That's been a stock everyone's been watching this summer after the
outage. Yeah, so I mean, of course, we saw that global IT outage. Thankfully, I was able to get on a plane right before this happened, but I heard there were so many delays afterward. Blessings to me. But we're seeing shares of CrowdStrike rising as much as 8.2%, and this is after their outlook was not as bad as feared. And it didn't seem that there's an immediate impact from that global outage that we did see in July on their earnings. And so this is the biggest gain the company has seen in terms of its shares in 2 months. And of course, shares are really trying to still recover from that outage. The company's shares fell as much as 36% in the aftermath from the global IT outage, but it has been trying to recover. And if we look at the 12 months prior to the outage, shares had more than doubled. So investors are really keeping an eye here.
All right, Nora Melinda, thank you so much. We appreciate that. As always, Nora Melinda, she covers the equity markets for Bloomberg News. Bloomberg Market Drivers today is brought to you by Interactive Brokers. Portfolio analysts consolidate and analyze all your financial accounts in one powerful dashboard for free. Sign up for Portfolio Analysts at ibkr.com/free. PA. Let's turn to those retailers. I mean, Dollar General, the numbers came in below expectations, guidance below expectations, stock well below expectations. The stock's down 28% today, hitting an all-time low. My question, Emily, and we'll talk to Jen Bartashis, she's at Bloomberg Intelligence. My question is just the consumer versus Dollar General specific. So, Jen Bartashis, Bloomberg Intelligence, thanks so much for joining us here. I'm trying to get a sense, Jen, of kind of how much of this is just the lower-end consumer facing economic headwinds versus Dollar General just doesn't have it together in terms of good stores, good product, good inventory management. Help us break it down.
Yeah, good morning, Paul. So when we look at Dollar General, we do think a lot of their current troubles are self-inflicted. There's no doubt that the low-income consumer is under pressure, but this is their core consumer that they know better than anybody else. And the fact that they're misreading where that consumer is and not ready to serve them in the way that they need to be served is a little bit concerning. So we're looking for, they're saying that they're going to increase, spending on promotions. They're going to mark down prices, try to get customers back into stores. But we'll be really watching them for the rest of the year and how they execute against those plans.
So John Tucker was talking about how Dollar General needed to improve their store experience, perhaps take up a broom, get a mop. I mean,
just like once a week, maybe somebody clean the store.
How much of this is actually about the products that they're offering versus the in-store experience when we talk about Dollar General trying to lure customers back in?
It's a great question. And having clean, safe, well-lit stores is a basic of retail. And, when Dollar General says they're executing on a back-to-basics strategy, that should be part of that strategy. We've all seen reports of just, boxes piled in the aisles and unable to navigate, and consumers, not having a great experience in store. I think that is improving. It's just not yet at the pace where it's consistent across their entire chain, and where consumers are really responding to it.
Hey, Jen, if the consumer doesn't go to Dollar General, where does that consumer go?
Well, it's interesting, but we're seeing big market share gains at the likes of Walmart, also in the hard discount grocers like Aldi. So, consumers are looking for where they're going to get the best deal, and whether that's on an everyday low price at something like a Walmart or an Aldi, or they're doing more cherry picking of deals, at regular grocery stores or other types of retail stores, buying things specifically on promotion in order to save money. So, Dollar General talked about not getting enough of the available share that's up for grabs. But part of that is that other companies like a Walmart are really executing well right now and are capturing more of those consumers.
Let's talk about the stock, because it is down 28% right now, the worst intraday drop on record. Wow. What do you make of that move? Is that really justified today?
Well, that's a very, very steep drop. And I think part of the reaction is that in the second quarter, the kind of sentiment was that the turnaround plan was gaining traction. And all of a sudden, the bottom sort of fell out of that. And that's the response that you're seeing with the stock today. Is it as bad as, as the stock price might be saying? It's hard to say. I mean, they still had positive same-store sales. They still had positive traffic into stores. They seem to have a plan for how they're going to build on that in the second half. But it really, at this point, the message is that people want to see execution by the management team.
Hey, Jen, thanks so much for joining us. Really appreciate it. Jen Bartashes, she's a senior retail analyst for Bloomberg Intelligence. Let me tell you, folks, we asked Jen Bartashes to join us, 12, 13, 14 years ago, Bloomberg Intelligence. She was already a seasoned Bloomberg executive. And she's like, I'm not a research analyst. We said, no, you're really, really smart. We'll teach you how to be a retail analyst. And sure enough, here we are, and she's one of the leading voices on Wall Street. We appreciate getting a few minutes of her time. She really knows the retail space, helping us break down the Dollar General stuff, so we appreciate that. Let's switch over to NVIDIA here. I mean, stock's down 2.6%. I don't know. I thought the numbers were darn good. I need some perspective on this name. I need some perspective on AI, because to me, and I think for a lot of listeners, a lot of viewers, AI is still something new. It's a new technology. I'm not really sure what it is. But our next guest has been really helpful in explaining what AI is and explaining what the opportunities are, and that is Gene Munster. He's a managing partner and co-founder of Loop Ventures, one of the leading voices, in my opinion, on all things technology. Hey, Gene, thanks so much for joining us. Can you give us your take on what we heard from NVIDIA last night and how we should think of NVIDIA and AI going forward?
Well, my take starts with what is a misunderstanding related to, I think, the narrative around this quarter and the guidance specifically. And the narrative is that the guidance is not as exciting as it was in the past. And so a few months ago, when they reported their April quarter, they guided the out quarter, the July quarter, up by 5.2%. So that's kind of the bogey. That's how investors thought about this October guide last night. And they only guided October up by 2.5%. And that diminishing return effectively on the upside is something that has dominated, I think, this view that that the second derivative is not working in the advantage of NVIDIA. That's just not, the beats are not, the raises are not as exciting. But that view misses a critical point. And it is very clear, even though they were not clear on the call, that this Blackwell chip, this next generation chip, was delayed by 3 months. And if you go back and listen to their earnings call 3 months ago, they were very clear. They used the word ramp in October. That's when the revenue was going to ramp for Blackwell. And now they're saying that that is going to ramp in the January quarter. So, Paul, if you take that revenue and basically bring it back into the October quarter, it's about $3 billion in revenue, they would have actually raised revenue by 12%. And I think, so that's an acceleration from the 5% raise that they did 3 months ago. I think that is, the reality is that this business continues to accelerate nicely.
Gene, I think intuitively, investors, when they see a stock that's run up so much so quickly, they get nervous that we've hit euphoria, we've hit peak AI. What are you telling, those investors who are just skeptical of just how quickly this stock has moved up higher? What are you telling them? Because you are still owning NVIDIA at Deepwater.
That's right. We still own this. And I would tell them, I would just ask a question about just fundamentally, how do they see AI playing out over the next several years? And if you believe that this is going to be truly transformative, more than, for example, the smartphone or the internet, I would tell them that just continue to stay the course. This is a rocket ship. You can debate whether you have a window seat, and that would be akin to your entry price to NVIDIA, or an aisle seat, but either way, this ship is going to continue to go up, because at the end of the day is that in order for AI to come to its full capacity of general intelligence and eventually super intelligence, we need to scale. And scale requires not only more compute capacity, but more data. If you continue to need more compute and data, then NVIDIA is going to be a beneficiary of that. And so we also have a venture investing business. We invest in technologies. Some of them compete with what NVIDIA is doing. And we know from that side how difficult it is to close that gap. And so I think they will continue, the market will continue to need their chips to enable what I think is a very robust outlook for AI. And just to put a final thought on, Emily, is that I think we're in a 3 to 5 year bull market. Still early. I don't think we're even close to a peak. I understand why people are nervous when you see the move in NVIDIA over the last couple of years, but I think it's an uncomfortable truth about this market is it's going to continue to go higher.
Hey, Gene, a reader just kind of piped up here and said, how about some of the competitors, like some of their customers might be competitors in terms of these chips? Frame that out for us.
So some of the customers make their own chips. Microsoft makes its own chips. You also have companies like Google has their Tensor chip. And so Amazon's working on different chips. And so these are the hyperscalers, and these are the parts of the business that have been kind of fueling a lot of the growth. And if you just think about in total how much of their growth has come from the hyperscalers, it's probably about 60% over the last year. And so it's been really important. At the end of the day is that I continue to believe that the hyperscalers will start to add some of their own chips. They still don't have the performance, and this is the central point. Just because you're creating a chip doesn't mean that it has the same performance as NVIDIA GPUs. And a big part of the call last night was Jensen trying to educate investors about how the hyperscalers think about the return on investment, and that there is a return on investment for buying these more expensive chips. And so simply put, Paul, is that just because they're working on chips doesn't mean that they are comparable to NVIDIA's GPUs.
Hey, Gene, thanks so much again for joining us. We really appreciate getting some of your time, helping us really understand what's going on out there in the world of technology and in this new phase of it, including AI. Gene Munster, he's a managing partner. He's a co-founder of Loop Ventures. He's based in Minneapolis. He's been covering the tech industry really for decades and gives us a good perspective on AI. And as I remember, Gene probably told us maybe a year ago, or maybe more than a year ago, kind of just how big AI is relative to things like, the internet and the electricity. And he puts it in that context, and that kind of gives you a good frame of reference for perhaps how big this AI can be for everyone. S&P 500 up 0.7%, the NASDAQ up 1.1%. We'll have more coming up. This is Bloomberg. Folks, Bloomberg is now on your dashboard.